Bonjour à tous et toutes. Bon lundi matin, bienvenue à la poursuite de l'audience pour la demande conjointe. Ah, pardon, on va lire le protocole d'ouverture.
Alors, audience du 20 juin 2022 par visioconférence. Dossier R-4156-2021, phase 2. Demande conjointe relative à la fixation de taux de rendement et de structure de capital. Poursuite de l'audience.
Merci, Mme Saint-Cyr. Alors, vendredi après-midi, on a reçu réponse à l'engagement numéro 4 que l'on estime satisfaisant. Donc, la preuve des demanderesses est close. Et s'il n'y a pas de questions préliminaires, on continuerait d'entendre Dr. Booth.
Bonjour, Monsieur le Président. Bonjour à la formation. Adina Georgescu pour Gazifère et Intragaz. Monsieur le Président, il y aurait peut-être une petite question préliminaire avant de continuer avec le témoignage du Dr. Booth. C'est simplement pour vous dire, vendredi passé, lors du contre-interrogatoire du Dr. Hopkins, il a été mention d'une décision de l'Alberta lors du contre-interrogatoire ainsi que d'un règlement de la Ville de Montréal. Maître Hamelin, pendant la fin de semaine, nous a demandé de lui communiquer l'information, juste vous informer que la décision qui a été rendue en Alberta a été déposée vendredi dernier sur le SDE. Quant au règlement de la Ville de Montréal, il va être déposé dans les prochaines minutes. Et à ce sujet-là, relativement au règlement de la Ville de Montréal, tout particulièrement, en révisant nos notes de l'audience au courant de la fin de semaine, nous avons réalisé qu'une question de contre-interrogatoire qui a été adressée au Dr. Hopkins relative à ce règlement tout particulier a été formulée de manière un peu générale et aurait bénéficié peut-être davantage de précision pour éviter toute confusion. Donc, dans un souci d'efficience et avec l'autorisation de la Régie, nous suggérons de reformuler la question par lettre, qui est d'ailleurs déjà prête et qui pourra être déposée sur le SDE dans les prochaines minutes également. Et si cette reformulation requiert du Dr. Hopkins une réponse différente de celle qui a été donnée à la question initiale, nous suggérons que cette nouvelle réponse puisse être soumise par voie de déclaration sous serment d'ici la fin de la semaine. Et dans la mesure où la réponse initiale qui a été donnée demeure la même, à ce moment-là, il n'y aurait pas de nécessité qu'une déclaration soit déposée. Et si dans le délai, d'ici la fin de la semaine, nous ne recevons rien, nous prendrons pour acquis à ce moment-là que la réponse initiale est maintenue. Donc, c'est un peu la façon de procéder que l'on suggère dans la mesure où cela satisfait la Régie et où ça convient à Maître Hamelin également.
Un commentaire, Maître Hamelin?
Écoutez, c'est un peu non orthodoxe, si je peux dire, comme façon de procéder. Je vais premièrement m'assurer que le Dr. Hopkins est toujours disponible là, parce qu'il avait été naturellement libéré. On va regarder la question, on va revenir à la Régie si on voit un problème là, avec la proposition de ma consoeur. Et naturellement, sous réserve des disponibilités du Dr. Hopkins. On va faire dans notre possible de le rejoindre et on verra comment parce que naturellement, là, il est libéré, mais on lui demande cette question-là. Alors, on va voir comment on agit dans les circonstances.
Très bien. Maître Georgescu, vous pouvez déposer votre question, puis on verra par la suite.
Parfait.
Donc, moi aussi, Monsieur le Président, si vous me permettez, j'avais un point d'intendance très rapidement. Le Dr. Booth, on avait annoncé 1 heure en chef. Là, ça fait 1h15, puis on est à la slide, disons, 16 sur 51, donc un petit peu moins du tiers. Si on pouvait juste avoir une estimation, là, on en a pour combien de temps, parce que ça risque de faire un peu dérailler le calendrier d'audience là, si on triple le temps annoncé en chef, parce que moi, j'ai quand même beaucoup de questions en contre-interrogatoire. Et on avait annoncé 3 heures.
Alors, on est conscient de ça, Monsieur le Président. On va tenter d'y aller plus rondement avec le restant de la présentation du Dr. Booth. Là. Alors, on pourrait peut-être passer en anglais là, si, pour les fins de l'exercice, mais je pense qu'on va être en mesure de le faire dans le temps, en fait, pas dans le temps qui avait été annoncé parce que déjà on est dépassé, mais pour tenir compte du contre-interrogatoire de mon confrère. Alors, on va tenter d'y aller plus rondement pour la suite de la présentation.
Très bien. Merci.
Merci, Madame. J'allais simplement dire merci, Maître Hamelin. Excusez-moi, je ne voulais pas vous interrompre. Allez-y.
Non, peut-être que juste pour les fins de l'exercice, Dr. Booth, just to let you know, there were some questions with respect to the examination of Dr. Hopkins referring to a bylaw of the City of Montreal. An additional question will be asked in writing to Dr. Hopkins in order to answer to that question and referring to we'll see the question to Dr. Hopkins pertaining to the bylaw of the City of Montreal. With respect to a decision that was referred to Dr. Hopkins in his cross-examination, this decision has been filed Friday. It's the AUC 2023 generic cost of capital. So that was filed Friday. With respect to the timing of your presentation, the question was asked as to, since we had announced a certain number of hours, and I indicated that we will be proceeding maybe in not expedite version, but we will be sure that there's sufficient time for the utilities to proceed to your cross-examination today. So having said that, I think that Dr. Booth is still under the same hold, and I think he can now proceed, Mr. Chairman.
Yes, we're ready.
So, Dr. Booth, I think that we closed your presentation by discussing the, I think the next slide in your presentation, and Madame la Greffière, maybe we can put back the presentation of Dr. Booth. I think it's CASIG 87. And if you go to the page, which was, I think, fair ROE. And from now, it's the next page.
Okay, first of all, I'd like to apologize to Council and the Régie for taking too long. But I can blame my lawyers because they asked me to counter several things in Dr. Villadsen's direct testimony. And as a result, it's added time to what I originally planned to say. So in terms of my presentation, the first third of it really is on business risk. And this is business risk from the sense of the capital markets, not on the nitty-gritty, which Dr. Hopkins gets into. So the second part here is referring to my direct estimates on the fair ROE. And the final part, which essentially has been added at the request of counsel, is to deal with some of the things that Dr. Villadsen said. So in talking about the fair ROE, Dr. Villadsen and I both use the same techniques. The two basic ones are the risk premium model, where the capital asset pricing model is one variation of that, where the core of it is the risk value of money and the time value of money. And then the discounted cash flow simply sets the market prices and try to work out what on earth were the investors doing given a stream of cash flows that the firm is expected to earn. So we're trying to sort of work out what the investors are doing. So Madame Saint-Cyr, can you change to the next overhead, please? So the two critical methods, they work best in aggregates. The more you get down to individual companies and individual securities, the more difficult it is to interpret any model. There's more uncertainties. So I start out looking at the big picture in terms of the overall capital market, because when you look at the capital market as a whole, a lot of things disappear through diversification. So for the capital asset pricing model, for example, we've got the time value of money and the risk-free rate. And then we've got the risk premium for the individual security. And there is significant disagreement with Dr. Villadsen and I on the correct relative risk of utilities, the beta coefficient. There's less disagreement between us on the market risk premium. In fact, her historic market risk premium of 5.68% is indistinguishable from mine, 5.5 to 6%. Similarly, when we look at the discounted cash flow model, we're essentially looking for the aggregate market of the dividend yield on the stock market plus long-term growth. Now, it's important here to recognize that that model comes from a very, very specific model for valuing stocks. It assumes that the growth rate in the dividends goes on to perpetuity, and we can use the formula for a geometric series to get a closed form for the value of the stock, and as a result, the dividend yield plus growth model results. And that growth rate is technically the constant growth rate in perpetuity. For individual stocks, this causes enormous problems because no company can grow at, say, 9 or 10% in perpetuity when the stock market's only, overall market's only growing at 3.5%, 4% in long run growth. So there's a constraint on that for individual stocks that doesn't exist for the stock market as a whole. So I start out looking at these two models because they work better under different sorts of economic circumstances. So if you set the beta is equal to 1, we've got the estimate for the market return. And if you set the growth rate equal to the long run growth rate in the economy, which is basically the most the earnings can grow at, otherwise earnings and dividends will increase exponentially as a percentage of GDP. And eventually all of the GDP will be earnings to the stock market rather than wages or salaried employment or anything else. So when we do that, and next slide, please. And this is what I've done here. I've looked at the overall stock market, not individual securities, because it's a lot easier to use these models for the overall stock market. And I've assumed the market risk premium was 3.5%, which is basically what I was using about 20 years ago, and long run growth rate. And the long run growth rate was about 3.5% 20 years or so ago. So these are long run values going back decades in terms of the trade-off between equities and bonds. So can we go to the next slide, please? And when you do this, and in this case, subtract the risk premium estimates from the DCF estimates, we get an idea of when these models performed well and when they performed badly. For example, you can see in the 1970s, the DCF models were giving higher values than simple risk premium models. And I call them naive because I'm using the constant market risk premium and constant growth rates. In contrast, in the 1980s into the 1990s, risk premium models were giving higher rates return to DCF models. And then since about 2006, we've got simple DCF models giving higher values than risk premium models. So this is basically to set up the fact that I look at both DCF and risk premium models. In fact, I look at anything that is available to get insight into what investors require in terms of a fair rate of return. Now, the critical thing, next slide, please. The most objective, critical problem has been the long-term bond yield. And now, similar to the 1970s, we've got negative real long-term bond yields, or have had until very, very recently. And this is causing problems with the risk premium models. And this has been recognized by several authorities, including the REGI, in past decisions. And when we look at this, this is the graph of the Treasury bill yield and the long-term bond yield. Up until 2008, we can see that the pink line basically touched the blue line, which means the Treasury bill yields were almost at the same level as long Canada bond yields. And that was because at that time, the Bank of Canada was actively trying to slow down the economy because we were actually had inflation above the 3% top of the Bank of Canada's target range. That changed dramatically because of problems in the United States. The United States, great financial crisis, they almost destroyed the US banking system. starting with the collapse of Bear Stearns in 2007. The enormous bailout of Citibank. The US seriously damaged the core of the economic system, which is investment banking and the banking system. And as a result, we got this dramatic drop in interest rates in 2008 and 2009. And then Canada started recovering very, very quickly because we were sideswiped by the United States, but we never suffered the serious problems that the United States suffered. And by 2009, 2010, the Bank of Canada was increasing the overnight rate, normalizing, as it were. And the last time I was here for a GMI Gas Metro hearing was in 2011. And as we can see on the graph, by then we'd already increased interest rates in Canada several times. And the forecast for the long Canada bond yield was 4.5%, 4.55%. And then again, we were sideswiped by the Americans. In fact, from that period, 2011, the GMI hearing, right up until the end of 2019, I referred to it generally as waiting for Godot, where the Americans were Godot. Canada was basically treading water for the best part of 5 years, waiting for the Americans to solve the core problems in the US financial system and for the US to get back to normal. This was a period when there was massive central bank buying of bonds in order to depress long-term interest rates. And some of that spilled over into Canada because the capital markets are obviously closely related, the US and Canada. We thought we were getting out of this at the end of 2019. And then, of course, we heard about this virus coming out of China. And by March 2020, we were deep in the mess again with lower interest rates. So when you look at this, in terms of the risk premium model, the basic problem has been the long Canada bond yield. The next slide, please. When we look at long-term bond yields, it has been a deliberate policy of the Bank of England, the European Central Bank, the Federal Reserve to lower long-term interest rates. And they've done this by massive buying of long-term bonds, primarily government bonds. In 2008, before the US financial crisis, the combined central banks had a balance of about $4 trillion worth of bonds. By the end of 2021, that was up to $24 trillion. So that's $20 trillion. And I'll say that again, trillion, not billion, not million, $1 trillion worth of bonds have been taken off the capital markets by the actions of the central banks. That deliberate buying was to lower interest rates. So that what we've got in the capital market is artificially low long-term interest rates. And we've got a distorted view of the trade-off that investors would otherwise make between bonds and equities and other financial securities. Next slide, please. Back in 2011, 2012, I was trying to get a handle on this. And I did that by looking at preferred share yields. Now, preferred shares are part of equity. They're equity securities. They're paid out of net income, and they're paid after we pay taxes and after we pay interest. They are not bonds. They behave very much like equities, with the twist that they've got a fixed dividend, a preferential dividend. Traditionally, preferred share yields have been close to the yield on A bonds, and we see that in this graph up until 2011. Once the US in particular started this massive bond buying to depress yields on bonds, the preferred share yields didn't react to the same degree because they're equities. They are basically a made in Canada product because of the way in which we tax dividends. They're not as affected by central bank bond buying. And we can see that starting in 2011 with this massive central bank bond buying, preferred share yields did not go down to the same degree as A bond yields and long Canada bond yields. At that time, I said, look, we cannot build a fair return off distorted long Canada bond yields. Look at preferred share yields. to indicate what is happening on equity rates of return. And I think it was in a Hydro-Quebec or Intragas hearing, I said the forecast long Canada bond yield was 3%, but looking at the behavior of preferred share yields indicates that that's at least 0.8% below where it would be but for the actions of the central banks. So I added 0.8% to the forecast long Canada bond yield at that time. And ever since I've said, essentially, I'm not changing my fair rate of return until we get a normalization in the bond markets and until we get long Canada bond yields above 3.8%. And I started saying that in 2011, 2012, and I'm still saying that. Next slide, please. So where are we now? This was the federal government's budget in 2021. And if you look at the second row, it has the 10-year government bond rate, and it has it going out to 2025 at 2.7%. That was based on consensus forecast. For the last 20 years, the government has relied upon consensus to avoid any sort of complaints that is coming up with biased long Canada forecasts simply to ease its financial problems. So that is based upon consensus forecasts. That was a year ago. This March, the Parliamentary Budget Officer came out with a forecast. And again, long-term bond yield by that time was 3%. Adding the spread to the 30-year bond, I come up with 3.37% as my best estimate of the long Canada bond yield, essentially at the end of a 3-year test year. That's still 0.43% below what I regard as the minimum yield reflecting a trade-off between bonds and equities by private individuals. So I add 0.43%. I call it an Operation Twist adjustment because it was a deliberate attempt by the Federal Reserve and other central banks to twist the relationship between short and long-term interest rates, and in particular to lower long-term interest rates. Next slide, please. So if I compare my forecast with that made by the Régie in its 2011 decision on Gas Metro, at that time the risk-free rate was 3.9 to 4.5%. At the moment, I have it at 3.37%. The Régie used a market risk premium of 5.5 to 5.75%. I use 5.5 to 6% at the moment. The Régie used a beta of 0.5 to 0.6. I use 0.5 to 0.55. So on that basis, the major difference is the change in the long-term interest rates since 2011 as a result of this central bank bond buying. The Régie added 0.25 to 0.35 for Gas Metro's added risk. I don't do that because I still believe that giving them a 46% equity ratio versus the 37%, for example, for a gas distributor in Alberta, is the adjustment for risk. We generally tend to adjust for business risk in common equity ratios. We still do see adjustments in the allowed ROE, but I regard the extra common equity ratio as adjusting for Gas Metro's risk. And that's the same as I said in 2011. The Régie allowed 0.25 to 0.5% for other models. That's really what I regard as my 0.43% for Operation Twist, which gives the overall result. One final thing the Régie did in 2011 was adjust for credit spreads. And here there has been a significant difference. When we were looking at this in 2008 through 2012, we were worried about the fact that credit spreads over long Canada bond yields were relatively high, but they can be high for two reasons. One, the yields on bonds are high. The other is that the yield on the long Canada bond is low. And what we've now seen with more and more evidence that it's the long Canada bond yield that's gone down that's caused the increase in spreads, not any adjustment for risk. In fact, bond yields in Canada and the United States are extremely similar. So I don't regard that as justifying any adjustment for credit spreads. So that's the change in my testimony basically now compared to 2011. Next slide, please. So the other elements are the market risk premium and the beta.
Excuse me, Dr. Booth, to interrupt you. Can we go back to the previous slide?
As long as you credit to your time and not mine.
Can we just, do you have any comments pertaining to Dr. Villason's statement that your beta is 0.74?
I do. I put it here, but I'll deal with it. I think it's easier to deal with it when I talk about my betas.
Perfect.
But my beta is not 0.74 for reasons I'll get to. My
Thank
beta
you.
for utilities, as I say, is in a range of 0.5 to 0.55. So next slide, please. So my risk premium, I'm using 5 to 6%. For the last 10 years, I bumped it up a little bit to 5.5 to 6%, mainly because of this continuation of incredibly low interest rates. And there was a survey, a small survey, I'll admit, but a survey of professional institutions, and they said the three major sources they relied upon for the market risk premium were Fernandez's survey, Professor Damadoran at NYU, and Duff and Phelps. So I included those three because they're the ones that are most frequently referenced. So when we look, for example, at Fernandez's survey, and Madam Sancia, can you click on that and make it bigger so we can all see it? Okay, so here we have 1,756 responses in the United States for an average of 5.5% and a median of 5.5%. The minimum was 3.1% and the maximum 8%. I mention that because in Dr. Villas's evidence, she has a market risk premium of 8.05%, which is beyond the top of the range of 1,756 responses in the United States. But Fernandez, 5.5%, well within my 5 to 6% traditional range, and a little bit lower than the 5.5 to 6% that I'm using at the moment. So if we go across to look at Professor Damadoran, he's a professor at NYU, and he's written a popular textbook on valuation. And he has estimated the implied risk premium going back to 1960. And you can see his estimate in the 60s and 70s was 3%. And in fact, I was using, as I said, 3.5% at one stage. And most recently, it's been in a range 5 to 6%, very similar to mine. His estimates, I think, are biased high because they're estimated over the 10-year yield instead of the 30-year yield. And they're based upon analyst forecasts, which I regard as being over-optimistic. So next slide, please. And the final source is Duff and Phelps. Duff and Phelps now have rebranded themselves as Kroll. They bought the Iverson data that was used in rate hearings for a long period of time. Their latest, and this I think was April this year, 8.5% for the overall stock market. 3% normalized US risk-free rate. And I stress normalized. I'm not the only person that sort of doesn't accept current long-term bond yields. And a 5.5%, what he calls equity risk premium, but what is commonly referred to as the market risk premium. And if you look at that, you can back out the expected return on the market, which is the sum of those two, 8.5%. And you can see as well, the long-term forecast for the stock market as a whole, the base for the market return hasn't been above 10% until we go all the way back to 2008. And that sort of anchors all of the recommendations. You can't have a low-risk utility having an equity cost higher than that of the overall stock market. That's just risk positioning. So next slide, please. So that's the market return and the market risk premium. These are my estimates of Canadian utility betas using the utility subindex of the Toronto Stock Exchange, estimated in the normal way, 5 years of data over monthly returns, going back to when Standard & Poor's rebased our indexes back in 1987. So this is the longest period possible. The purple and the dark blue lines are the betas. And there was a concern in the early 2000s that the betas were unusually low, and why was that? And one reason given at the time was the interest sensitivity of utility stocks, and that's measured by the green line. It's essentially saying how sensitive are utility stocks to interest rate declines. And we can see that during this period in the around the 2000s, interest sensitivity was relatively high and betas were relatively low. But when you look at this whole time period, betas on the utility subindex have been around 0.4, 0.5, with absolutely no sign of a tendency of those betas to drift towards 1. That's just incompatible with the historic beta coefficients, relative risk coefficients in Canada. Next slide, please. So this is where I think Dr. Villadsen got my 0.74, because if you look at the last column headed Booth, you see average 0.74, median 0.67. And these are my beta coefficients, estimated by myself using the underlying data, estimates from Reuters, estimate from an independent research group called CFRA, estimates from Yahoo that uses Standard & Poor's data, and estimates from RBC. And when you look at these estimates, you see that they're all very, very similar. We're all doing basically the same thing. So the estimates might be over slightly different time periods. Reuters are in yellow because they estimate the betas relative to the US market index rather than the Canadian market index. And as you see, it tends to be that they're a little bit lower estimated against the US market index, except for Fortis. But these are the estimates for all of the stocks that we've got in Canada. The only other one I might include is Ontario Hydro, but there's still relatively recent data on that. But it includes TransCanada, Enbridge, and Pembina, which are not utilities, they're pipelines. So if we go to the next slide, and this is Schedule 4, I state very clearly that the pipelines risk has increased relative to utilities risk, and they're no longer compatible with standard rate of return regulated utilities. Now, we all know the problems TransCanada's had with its XL pipeline into the United States. It was approved and unapproved and then approved and unapproved. There's a lot of risk attached to TransCanada and its pipelines in the United States. Enbridge is now in a battle with the governor of the state of Michigan, who wants to decertify or not allow its Line 5 under Lake Michigan. So, and Pembina acquired Fort Chicago, which used to be, Verizon, which used to be Fort Chicago. And it had a lot of risk because it basically doubled its size, borrowed a huge amount of money to finance the acquisition. So all three of those have got very high betas. They are not reflective of the risk of utilities. So I don't think it's appropriate to use a beta of a pipeline that is demonstrably riskier than rate of return regulated utilities in terms of an estimate. And it's certainly not my estimate of the beta of utility risk. Next slide, please. Dr. Villadsen also claims that my Canadian utility betas have been higher than the US since 2015. That again is not correct. If we look at the estimate for the US gas companies, the last few betas, 0.44, 0.3, 0.2, 0.22. We look at the Canadian utilities, not the pipelines, the utilities, 0.32, 0.29, 0.28, 0.23, 0.16. There's no evidence that Canadian betas have been significantly higher than US betas since 2015. In fact, the last couple of years, they've been lower, marginally lower, insignificantly lower, but there's no evidence that they've been greater. Next slide, please. So when we look at these US betas, the US ones are almost exactly the same as mine. RBC, Yahoo, CFRA, absolutely identical for mine for one gas. Slight differences in some of the others, very similar to RBC on a number of these. My overall average 0.44, median 0.49, RBC 0.42, 0.47, Yahoo 0.43, 0.47, Reuters 0.36, 0.34, CFRA 0.43, 0.46. So these, I think there's pretty solid evidence that, first of all, these are not adjusted betas, and secondly, that they demonstrate the obvious, that this sample of US utility holding companies are low-risk utilities. They are not as risky as the overall stock market. Now, why aren't utility betas adjusted? And there's no evidence that they are adjusted. And this is what's called the Bloom methodology. And just to sort of explain what Bloom did, he looked at the betas in time period T, so that's beta subscript T, against a period without overlapping data. So he went back 5 years because basically we estimate betas over 5 years of monthly data, and said, what's the relationship between current betas and betas 5 years ago? Is there any tendency for them to move? And that's what this is. This is really what we call a partial adjustment model. Now, for all stocks, he estimated alpha 1 at 0.33, alpha 2 at 0.67. So the equilibrium beta is where beta T equals beta T minus 5. So all that it involves is taking that beta T minus 5 to the other side and setting it equal to beta T. So we get 1 minus alpha 2, and then dividing it into alpha 1. So 0.33 divided by 1 minus 0.67 is 1. Now, what I say here is that should be 1. It's a tautology. The overall beta for all of the stocks in the market is 1. So when you do this test on the overall market, you would expect some sort of drift of betas towards 1, unless you know something specific about the stock. And Bloom knew nothing about the stocks. He just estimated over all of the stocks in the capital market. Now, way back in 2001, my late colleague, Dr. Berkowitz, and I replicated Bloom for Canadian utilities. And that time we had, I think, about 14 pretty much pure regulated utilities. We don't have them anymore, but we did have them then. And we estimated Bloom's relationship, beta T is equal to 0.947 minus 0.822 times the beta of 5 years previously. Doing the same thing to find the equilibrium beta is 0.947 divided by 1 minus 0.822. Solving, the beta is equal to 0.52. That is what I've always referred to as the long-run beta for a utility, based upon what Mike and I did 21 years ago. And that still reflects the fact that there's no sign of betas drifting towards 1. We did that 21 years ago. We cannot replicate it because we don't have those companies. The two other studies, only studies that I'm aware of, have done it in the United States. And they similarly find that the adjustment process for betas is towards their grand mean, their mean, not the mean of the overall stock market. And just to emphasize, there is absolutely no statistical evidence indicating that betas for utility stocks adjust towards 1. Absolutely no statistical evidence whatsoever. Okay, next slide, please. The REGI recognized this in 2011. That was the Dr. Moran presented adjusted betas. And without reading everything, I'll just say, with respect to the use of adjusted betas, the REGI maintains the position it has taken in previous decisions. So the REGI has made a decision on adjusted betas several times that they do not adjust towards 1. And that is the correct result because there is no statistical evidence to support that. Next slide, please. Now we have the ECAPM. And I will say here that the original statistical studies of the capital asset pricing model did find that with betas above 1, the CAPM overestimated returns, and for betas below 1, the CAPM underestimated returns. And that's why the empirical capital asset pricing model has this slightly flatter line. It's got a higher intercept and it's got a flatter line. I don't disagree with that. That is the result of the empirical studies. Now, that hasn't been updated for decades because finance has moved on, and we now basically, the state of the art is to estimate multi-factor models. But that is absolutely correct. I don't disagree with that. But you have to recognize that in testing the ECAPM, it was estimating returns over 30 days. It was estimating the betas, coming up with a portfolio of betas, and then estimating the 30-day return. So the Treasury bill yield, 30-day Treasury bill yield was the risk-free rate, and the betas were not adjusted. They were the actual betas. So when we estimate that, the ECAPM, if you're going to estimate it consistent with the empirical results, you should use unadjusted betas and you should use the Treasury bill yield. If not, what you're estimating has nothing to do with the empirical capital asset pricing model. So that is not what Dr. Willison does, and it's not what her mentor, Dr. Wilbert, did back in 2009. And at that point, I asked Dr. Wilbert, please estimate the ECAPM in the way that it was tested. And next slide, please. And Dr. Wilbert's answer, in the interests of time, I will only read the first line. The results of the requested estimates would all be economic nonsense. So in 2009, Dr. Wilbert was asked to estimate the ECAPM in the way it was estimated that justifies his use of the ECAPM, and he said it would be nonsense if he did that. The reason is that the Treasury bill yields were so low, and he didn't even use adjusted betas. If he used he did use adjusted betas. If he didn't use adjusted betas, the results would be even more nonsense. So next slide, please. Dr. Moran presented this in 2011. He presented ECAPM estimates, and the Régie said, the Régie has already ruled on the ECAPM. In the Régie's view, there is no new information that would warrant a reconsideration of this model. And there is no new information in Dr. Willison's evidence. She is using exactly the same references that Dr. Wilbert used 13 years ago. There's nothing new that she has presented. And I would suggest that if she hasn't presented any new evidence, then if she actually implemented the ECAPM in the way that it was tested, her results would be nonsense as well. Now, I did correct this in my testimony on page 57. For some reason, I copied in the wrong quote from the Régie. So this is the quote that's in the beginning of my report, and that's the quote that I meant to enter. And in the quote below, I referenced Dr. Moran, and I should have referenced Dr. Wilbert. So those are corrections on my testimony. So that's the capital asset pricing model. The ECAPM, Dr. Willison is not estimating it the way that it was estimated, and there's no justification for adjusted betas. Okay, next slide, please. Now, one thing that has changed over the last 5 to 10 years is that a lot of the investment banks have put their expected long-run returns on the webpage. They're using them as basically advertising to try and get people to look at their forecasts and use them for asset managers to think in terms of asset allocation. The TD's forecast in 2016, so that's a little bit of out of date now, and I've actually got the 2019 report that I became aware of recently. And at that time, in 2016, if you look at the S&P composite, long-run expected rate of return, 7%. S&P 500, 7%. MSCI Europe, Africa, Far East, 7%. Government of Canada bonds, 3.5%. The difference to market risk premium, 3.5%. Now, this is a long-run risk premium, what we might say is compound returns. I don't recommend doing that. I recommend that they be adjusted to arithmetic returns similar to my market risk premium estimates, and they get up to the normal range of 5 to 6%. But the point is the long run returns are about 7%. Next slide, please. I've provided several of these in my evidence. I didn't want to present all of them. All I've got here is BlackRock's, BlackRock is the biggest fund manager in the world, and basically they manage trillions of dollars of funds, and they produce a long-run forecast, and this is taken directly from their webpage. And if you drop down into the middle of those green lines where they have equity returns, you see U.S. equities, and the round dot is the middle of the range of possible values, and that looks to be about 7.5%, consistent with the forecast of TD, and small caps marginally greater, but not materially greater than large cap stocks. And similarly, government bonds down there in yellow, it's about 2.5%, their forecast for long run returns. And these are long run returns, they're 30-year returns, because when we're looking at the market risk premium, we cannot think in terms of the next 3 or 4 or 5 years. We're talking about holding equities for a long period of time. So that's just extra information that's out there. So next slide, please. So these are my overall estimates, and I found a second typo. I'm sure there are other typos in my report, but the top line 7, it should be 6.55 to 7.1%, and 1 and 4 are very close on the numeric keypad, and I must have hit 4 by mistake, but it doesn't affect any of my estimates. So there's my CAPM, or my risk premium estimate, on the first block, and the second is all of the discounted cash flow and the other information that I look at. Equity market returns 8 to 9%. The average Canada return on equity from Statistics Canada, 9.78%. Asset manager long run expected return, 7 to 9%. DCF equity cost for the S&P 500 utility subindex, 6.8 to 6.9. DCF equity cost for gas US utilities, 7.25%. When I come up to my recommendation, I look at a variety of indicators. And now that we have all of this extra information, there's no justification for just looking at, say, a DCF estimate or just looking at capital asset pricing model. Next slide, please. Now, I'm afraid this is what's really added to my presentation. The last time I was here for Gas Metro, I didn't need to do this, but because Dr. Moran did not use ATWAC, and here we've got my summary of Dr. Villison's estimates. The P's indicate the pages where I extracted that information. But for example, she's got the DCF constant growth model, 9.9%. Multi-stage 8.7, CAPM 7.6, ECAPM 7.7. So as I mentioned, her CAPM and ECAPM use adjusted betas, and the ECAPM I don't accept. So that's why they're slightly higher than mine. But if you took that out, they'd be very similar to mine. The DCF multi-stage is better than the DCF constant growth because that doesn't assume that unrealistic short-run growth estimates go on to infinity, as they can't. But the critical thing is she derives what I call leverage adjustments, and she refers to them as leverage adjustments as well. The way she does this is she estimates the ATWAC, the after-tax weighted average cost of capital, using market value weights, and she then bumps them up by relevering them using book value weights. So her 10% or 9.9% DCF becomes 12%, a 2% bump. Her DCF multi-stage 8.7 gets bumped up to 10.5. Her CAPM 7.6, a smaller bump, but still a bump to 8.5%, and her ECAPM 7.7 to 8.7%. So it's important to understand where this bump comes from, because her direct estimates to the fair rate of return, using the same sort of techniques as I use and other witnesses use, are significantly lower. So next slide, please. The first board that was subject to this was the Alberta Energy and Utilities Board in 1999, 23 years ago. And I've recorded this because this is the core of what she does. In essence, a regulated company's earnings are driven by the portion of the original cost rate base deemed to be financed by common equity. This fact results in a fundamental disconnect to the theory that market capitalization ratios, which have deviated significantly from book capitalization ratios, reflect the appropriate financial risk necessary to determine a fair composite return to be applied to the original cost rate base of a pure play regulated utility. That's a very long sentence, but the AUC is saying basically, we're not going to pay that much attention to market value weights. The appropriate weights are the book value weights. And they go on to say this is because the earnings of a pure play regulated utility are governed by and driven by the regulated return allowed on book equity. In other words, it is the book equity that reflects the appropriate financial risk necessary to determine a fair composite return for pure play regulated utilities. Now, as far as I'm aware, only Brattle witnesses use this methodology in Canada. There may be others in the United States, but I'm not aware of them. And neither Dr. Chrétien nor Dr. Moran made these leverage adjustments in 2007 and 2011. So this is something unique to the Brattle group. Next slide, please. So how do they do this? Well, this comes directly from Dr. Villadsen's testimony. She takes the DCF equity cost, which as far as I'm concerned is the end. That's what you're estimating. That's what the AUC says you estimate a market determined equity cost and apply it to book value. And then if you notice column 4, it says DCF common equity to market value. Column 6 says preferred equity to market value. Column 8 says debt to market value. So these are all using market value capitalization rates that the AUC rejected. And she calculates the weighted average cost of capital. Now, in 2009, this was what Dr. Colby referred to as the after-tax weighted average cost of capital, ATWAC. And it's what the Régie rejected, ATWAC. And it's interesting to note that she doesn't refer to as ATWAC. She's changed the terminology. It's now weighted after-tax cost of capital, but that's exactly the same. It's the ATWAC. In fact, this exhibit, there's a parallel one in Dr. Vilbert's testimony in 2009. So if we go to the next slide, what is ATWAC? I taught this in my business finance course just a couple of weeks ago. It is totally standard to estimate the ATWAC. It's the minimum rate of return that a firm's investments have to earn in order to increase market value. It's the very basis of what we call shareholder value maximization. Since if a firm earns less on an investment than its ATWAC, its stock market value falls. There's a disconnect between the ATWAC and regulation. Regulation is not designed to increase shareholder value. It's designed to protect ratepayers from the exercise of market power. It is not designed to maximize shareholder value. So the very essence of calculating an ATWAC, I regard as incompatible with the reason why we regulate utilities, which is they have market power, and without regulation, they would undoubtedly abuse that market power and generate social losses. So if we go to the next slide, please. And here is the crux of what ATWAC does, which is that she derives an ATWAC using market values, and I have no problem with doing that. What I have problems with is using that market valued ATWAC and then saying, well, it's constant, and it's not constant, but she assumes it's constant, and saying, well, what happens if instead of having 49% common equity in the market value weights, we have 40% common equity? And clearly, if 5.6% is constant, the cost of the debt is constant, the tax rate is constant. If you just reduce the equity, you have to get a higher return on equity to satisfy 5.6%. This is arithmetic. It's not financial theory. It's the assumption that she makes that somehow you can take a market value ATWAC and apply it to a utility at the same level with book value weights. And that's what the Alberta Utility Commission rejected. But it's in this way that an 8.7% equity cost, which I would regard as marginally high for the multi-stage model, becomes a 10.5% ROE. And that's what the Alberta Utilities Commission rejected. And if we go to the next slide, it's what the REGI rejected. And you should think about what would happen if you believed Dr. Villadsen's APWAC and you said, well, okay, we're going to increase the allowed ROE from 8.9% to 10.5%. Well, already the stock prices of all of the firms in Dr. Villadsen's sample exceed their book value. The market weights are greater than their regulated weights. So the price to book exceeds 1. Well, if you get a bump in your ROE, the stock price isn't going to go down. The stock price is going to go up. And then you get an even bigger equity capitalization. And the ATWAC would go up. And the result is you then apply the technology again, the ROE goes up again. This is great for shareholders, but it is a fundamental disconnect between the way in which we regulate utilities. When we see a market to book ratio or a price to book ratio above 1, automatically we think the allowed or fair rate of return should be lowered. We don't think it should be increased. And this technology, this methodology, basically does exactly the opposite of what most economists would think about in terms of regulation, that we should remove economic rents and get prices a little bit above the book value, not give a higher allowed ROE that increases the market to book ratio. Okay, next slide, please. Now, Dr. Villadsen's added what she calls Hamada's, Hamada adjustments. So you have to go back to what she originally does. This is, sorry, I didn't mean naturally to go back. So you can go to slide 40. Thank you. So here are her estimates of the direct CAPM estimates. Risk-free rate 2.47. Bloomberg betas, which I think we've established they're not Bloomberg betas. They're betas that she estimated from Bloomberg data. The long-term market risk premium, which is not very different from mine. And then the CAPM and the ECAPM estimates. Now notice for TC Energy, TransCanada, the beta is 1 that she derives, and the ECAPM and CAPM are exactly the same, as they should be. It's only for a high beta stock, AltaGas, and AltaGas is no longer got regulated Canadian utility operations. It sold this Alberta operations to finance the acquisition of WGL in the United States. It's primarily still got some pipelines, feeder pipelines that feed the main line, but it's got a beta of over 1. And as a result, you look at it and you see the CAPM estimate is too high and the ECAPM estimate is lower. For all of the others, for example, for Hydro 1, beta of 0.71, the use of the ECAPM bumps up the fair rate of return. So that is what the ECAPM does. It increases the cost for low beta stocks. And as I said, theoretically or empirically, that's correct. But in practice, you have to do it in a way consistent with the empirical results, which is what she does not do. But even so, her estimates, CAPM and ECAPM 7.6, 7.7, they're very, very close to my own estimates. And in particular, her market expected return is simply the risk-free rate plus the long-term market risk premium, 8.15%. And if you believe that part of Dr. Villadsen's evidence, then you're basically saying the return to a low-risk utility should be less than 8.15%. Next slide, please. This is what she ends up with. Now, I've note 2 things here first. Energia has 46% common equity. The 7.5% preferred shares are deemed, as far as the rating agencies and everyone else is concerned, is common equity, and all it does is lower the overall allowed return on the common equity. So at 46%, you wouldn't expect this leveraging to do anything. And if you notice, it doesn't do anything. So if you look at scenario 1, and I reject scenario 2 because that 8.505% market risk premium is higher than any survey results from over 1,000 people responding to Fernandez's survey. So if you leave the fair rate of return as based upon 46% equity, which is my recommendation, her CAPM and ECAPM are indistinguishable from my 7.5% recommendation. She has 7.6 and 7.7. Different Hamada adjustments make really tiny differences because the leverage is basically exactly the same. The 40% deemed common equity, I'm confused here. I thought her recommendation was 43% common equity. Using a 40% simply gets a higher leverage adjustment. So at 43%, it would clearly be in between the 40 and the 46%. So next slide, please. How does she get this? Well, she does exactly the same thing as in ATWAC. She uses the market value equity weights. And we can see that in column 3, common equity to market value. We can see it in column 4, market value. We can see it in column 5, market value. And she has the income tax rate the same as the ATWAC. All she's doing here is calculating what we call the asset beta or the equity cost to an unlevered firm. But she's doing it using market value weights, exactly the same as she's calculating ATWAC using market value weights. And I discussed this in Appendix E to my testimony. The only thing different is I use the more conventional way of talking about the asset beta as the unlevered equity cost, rather than calling it an unlevered or asset beta. So that's really just a difference in notation. But the critical thing is she uses market value weights. And that means that this asset beta is higher than it should be. Okay, so we go to the next slide. The second is the relevering exercise. So Dr. Villerton relevers the betas using the regulated book values. This is exactly the same as using the constant ATWAC with book values. The core of this is market value estimation and then book value revaluing the fair return. Now, she doesn't get as much of a bump from this because the betas don't go very much. But what we've got here is what I refer to as a double adjustment. First of all, she adjusts her betas upwards to about 0.9, and then she does the leverage adjustment, which, given the capital structures are not that much different, only gets her a bump from 0.9 to 1.01 or 1.05. But the critical thing is Dr. Villerson is assuming that with these adjustments, Canadian Utilities, Energia, and not just Energia, but any Canadian utility, because there's nothing in this that says Energia, is basically higher risk than the stock market, which I simply don't accept. Next slide, please. So with these Hamada unlevered equities, so column 2, she says unlevered equity. I think that's incorrect. That's the relevered beta from the previous slide. So that's incorrect. But she then estimates the fair rate of return using the CAPM and the ECAPM with these double adjusted betas to get 8.4, 8.5, 8.2. And as I said, this doesn't do a lot for her estimates because the capital structure weights are not that different. But this is essentially exactly the same methodology, market value weights to estimate, book value weights to relever, as in the ATWAC. Next slide, please. So what did the Régie say about this in 2009? First of all, I quote the Alberta Energy and Utilities Board. They explicitly said they would be derelict in exercising their statutory responsibility to accept ATWAC-based leverage adjustments. And I'll say that again because I've never, ever seen a methodology rejected by a regulatory board saying they'd be derelict to accept this particular process. But the Alberta EUB, as it then was, said that they would be derelict to accept this process of relevering betas and using the ATWAC. And the REGI, when faced with this in 2009, again said conceptual difficulties involved in applying the ATWAC according to market values. So it's the market values that is driving these underlying results in the ATWAC, and it's the market values that's driving the underlying results in her leverage adjustments to the CAPM and the ECAPM. And the REGI rejected this in 2009, but the Hamada adjustments, leverage adjustments, are essentially doing exactly the same thing, only it's not as powerful in changing her allowed ROEs as using the constant ATWAC. Okay, final slide, please. So what's my conclusions? My conclusion is there's no evidence for increased business risk by the Quebec utilities, certainly at this point in time. There are increased risks out there, but the question the REGI has to address is, are these risks that will actually be reflected and be borne by the utility, or will they be borne by ratepayers? And the experience of the allowed versus the actual ROE is that invariably these are risks that, even if they materialize, get reflected and borne by the ratepayers, not borne by the utility. No evidence for materially increased betas or market risk premium. Significant evidence that there are real problems in the long Canada bond market. And as a result, the forecast long Canada interest rate, I don't regard as a good base for a CAPM fair rate of return. When you're looking at this, sometimes you have to fall back on common sense. And common sense is a risk hierarchy, which is to say, if you believe that regulated utilities in Canada are lower risk than the overall stock market, which is what their betas indicate, then their fair rate of return should be lower than the overall stock market return. And substantial evidence, I referred to TD and BlackRock, but my evidence has got JP Morgan, Northern Trust, Duff and Phelps. I've not found anybody that has a forecast overall long-run return on the capital market above 9%, which means that that sort of is a limit on the fair rate of return for a regulated utility. And I'll say again, absent adjusted betas, absent the ECAPM, and absent leverage adjustments, I should have put in there with book value weights, all of which the REGI has rejected. Dr. Villison's direct estimates are no higher than mine, or not materially higher than mine. They're certainly narrower than my estimates 11 years ago relative to Dr. Moran's, who didn't use ATWAC.
So thank you, Dr. Booth. I have no further questions, so he is available for cross-examination.
Donc, je suis à votre disposition. Je peux commencer maintenant ou on peut prendre la pause. C'est comme si je laisse ça à votre discrétion. C'est comme vous voulez.
Bon, on peut continuer. On peut faire une bonne demi-heure.
Oui, absolument.
Dr. Booth, I see that your picture is frozen on the screen, so maybe if you can try to put your camera off and then on to see if it can solve the problem. Yeah, that's good. Thank you.
Voilà. Je réalise que j'étais à mute, mais j'allais demander à Mme la greffière de retirer la présentation, donc c'est parfait. Dr. Booth, good morning.
Good morning, Mr. Wallet.
I'll have several questions for you this morning and most likely this afternoon. If at any point in time my question's not clear, feel free to ask me to repeat or reformulate. Sometimes I use French expressions in my English, so it's not always easy to understand. If that happens, let me know.
Moi aussi.
Great. Now, can you please turn to page 26 of your evidence? la pièce CASIG 0037.
Yes.
Donc, Madame la greffière, est-ce que vous voulez la mettre sur... On va attendre. We'll just wait for the clerk to have that on the screen. So that would be page 26 of the actual page number at the bottom. So that it would be net. Okay, good. Here we are. Okay, so I first like to discuss interest rates, Dr. Booth. So you'll agree with me that the risk-free rate is a key input into the capital asset pricing model?
Absolutely.
Now, on the middle of page 26 of your evidence, what we see in the middle of that page is a screenshot from the Bank of Canada's website, correct?
Correct.
And that was taken before the finalization of your expert evidence on April 8 of 2022, correct?
Yeah, it's the last one that I had.
Okay.
But they update it once a month.
So it was the most recent one at the time that your expert report was published. Is that correct? Okay.
And it's now gone up.
Well, yeah, I think you see me coming. So we'll look at how those numbers have moved since the filing of your report. So you do agree with me that all the figures shown here at the middle of page 26 have all gone up since your report was filed.
That's correct.
Okay. Now, I'd like to show you.
Canada's still lower than the US and the UK. The UK is now at 9%. The US, I think the last one was 8.7%. And we're expecting 7% headline CPI coming up this week.
I appreciate your comments, Dr. Booth, but I haven't asked you a question.
Oh, sorry.
Okay. So I want to show you what we have called Exhibit B0365. Donc, est-ce qu'il serait sur le... J'avais compris qu'il avait été ajouté sur le SDE.
Je ne le vois pas encore.
Effectivement, là.
OK. Donnez-moi juste une petite seconde, je vais consulter Maître Cloutier. We'll just let Madame Saint-Cyr give her time to find the document. So it's it's there. I'm told it is there. So B0365. Okay. At any point in time, Dr. Booth, if I show you a document on the screen and you want time to review it before I ask my questions, you let me know.
I will.
Okay. So what we see here is an extract of the Bank of Canada's website, which is the latest one, dated June, or it was taken on June 7th. So you agree with me that these are the actual figures. So the policy interest rate now is 1.5%.
Yes.
As opposed to 0.25% as it stood when your report was filed, correct?
I'd have to check to see exactly what it was when it was filed, but it's certainly 1.5% now, and it's gone up.
Okay. Now, but what we see on page 26 of your report, I thought it was the most recent data at the time of the filing of your report.
That's correct.
Okay, so if we go back to page 26, we'll see 0.25. No, 26 of the evidence, the one we were on before. Yes.
But that's correct. This was the last time that I've dealing with IGUA requires going backwards and forwards with clients. And in previous hearings, I basically filed my testimony myself without having to sort of draft testimony and then getting feedback. So this was the what I had in my report when I prepared my report that went to IGUA, and then there was some feedback in terms of spelling, typos, and presentation. So I did. You're I did not have time to make changes by the time it was filed.
Okay, so this was not the latest data available at the time of the filing of your report. Is that correct?
That's correct. It was the latest data that I had when I prepared my report, and I submitted it to IGWA.
Okay, and then you didn't recheck the data to have the most actual one at the time of the filing of your report. So that would be February data. Is that correct?
That's correct. It's significant amount of rewriting and redoing in a short period of time. It's like chasing your tail, Mr. Ouellet. So it's and I note, for example, that the testimony filed by the Brattle Group, similarly, the deadline in terms of the date on the document is not the date of the data. Unfortunately, when it gets a little bit bureaucratic, it's more difficult to control your own testimony in terms of filing.
Yeah, but you did hear Dr. Villassen's testimony, and she corrected her data to make it most up to date at the time she testified. You did not correct the data.
I've not corrected it because, as I've told you before, I've not changed my overall fair rate of return until we hit a 3.8% long Canada bond yield.
Okay, so
we're still a long way away from that.
Okay, so we'll do the corrections. We'll look at the information. So the
Maître Ouellet, j'aimerais juste que vous laissiez. Please let the witness answer the question because you're interrupting him when he wants to answer.
Vous avez raison, Maître Hamelin, je m'en excuse. J'ai été un peu prompt, mais j'ai quand même laissé le témoin terminer. J'ai tendance à vouloir poser ma question vite, puis je vais faire un effort pour ne pas le refaire.
Sinon, je vais revenir.
Et vous serez la bienvenue de le faire, il n'y a pas de problème. So let's look at the information, Dr. Booth. What I want to do is I want to compare the information we have in your expert evidence to the most up-to-date information. So the policy interest rate went up by 600% since the filing of your report, so from 0.25 to 1.5%.
Yeah, I prefer to say it was 1.25% rather than 600%.
But do you deny it's a 600% increase?
Well, that's one way of expressing it. But if I was to go on the media, as I've done several times, and say the policy interest rate has increased by 600%, jaws would drop. That's not the way we express it. So mathematically, you're correct, but that would be a misleading interpretation of the number.
So doing the math you're suggesting is misleading.
Frequently, it's misleading. Yes.
Okay.
You get very low numbers, then a small increase gets compounded in a very big percentage increase. For example, if the policy rate was like the United States, where they give a range where the lower bound was 0, any increase is a phenomenal increase from 0.
Okay, I will show you now document B0366. Donc, Madame la, oui, B0366. Okay. So maybe for everyone's sake, including mine, if you could make this a little bit bigger. Okay, so you see this document. You're familiar with this, Dr. Booth? An extract of the Bank of Canada website?
Well, I'm familiar with the Bank of Canada's website, and I'm familiar with his numbers, correct? Okay,
so we can see, and this is in the chart to the right, we see the policy interest rate changes. And we have the 0.25 that you have in your report. So that's January 26, 2022. So that's the figure we have at page 26. Now, you'll agree with me that on March 2nd, the policy interest rate had doubled, going from 0.25 to 0.5. That's correct?
That's correct. It's gone up 25 basis points, correct.
Yeah. And so that happened over a month before you filed your expert evidence, correct?
That's correct.
Okay. And you didn't think of changing the data on page 26 for data that had been available over a month before you finalize your evidence?
No, because it wouldn't have changed my recommendations.
It wouldn't have changed your recommendation. Okay, so these numbers here, they don't change your final figure at 7.5%. That's what we should understand. Okay. But since you're putting the data in your testimony, didn't you think it appropriate to give the actual accurate data?
I think you're absolutely correct that perhaps I could have gone through and redrafted that. But as I explained to you, I provided my testimony to IGUA and I wrote it in parts. And as you probably counted the pages, I'm at about 200 pages in terms of my testimony. And I drafted one, moved on to another, and then sent them to IGUA and got some comments stylistically. And I think you're probably right that I could have gone back and changed that, but then it would have gone back and they would have generated another round of changes. So I was warned that to this testimony, there'd be more interaction with counsel and members of IGUA because there were other bodies looking at my report. So I'd be 100% agree with you that perhaps I should have done it and I would have done it. For example, in 2011, when nobody looked at my evidence, I wrote my evidence and could submit it without anybody looking at it. I don't think Guy, at the time, the lawyer, ever read it before I submitted it.
Okay.
So I apologize for that, but you're absolutely correct.
Thank you for that, Dr. Booth. And the reason why I'm asking this question is if you look at page 7 of your evidence,
yes,
it's footnote 2. I don't know if you necessarily if we do need to put it on the screen, but at footnote 2, you reference a decision rendered on March 31st of 2022. So I would have thought that your data was actually up to date since at least that date, since you referred to something of March 31st. So did you adjusted some of the data, but not all of it?
I think it's fair to say that when something important comes out that affects my testimony, then I will put that in. That's correct. Okay. And I thought it was much more important that the REGI be aware of the Alberta Utilities Commission in determining the fair rate of return and capital structure than that the overnight rate increased 25 basis points.
Okay.
But I mean, for example, if I refiled my testimony now and put in March 31st in the screen capture, wouldn't change anything in my testimony. But the Alberta Utilities Commission decision, that I think the REGI should be aware of it.
If we could go back to the document I initially showed the witness, B0365. So I want to go back to the June 7th data, Dr. Booth, that I showed you originally.
Yep. This is my own testimony, page 26.
Yes, with the actual data from June.
Okay.
Okay, so you have this, and if we could have in front of the witness as well the 0365. Peut-être juste pour donner une indication, Madame la greffière, je vais revenir souvent à la page 26 du rapport du Dr. Booth quand je vais aller d'un document à l'autre. So I'm just advising the clerk, Dr. Booth, that I will come back to page 26 of your report several times. Okay, so here you have the June 7th data. So we looked at the spike in the policy interest rate. I'd like to look at inflation. So the data you had at page 26 of your report, CPI inflation stood at 5.1. Now it has increased to 6.8. Is that correct?
Certainly yes, that does indicate that that's the case. In fact, as I said, I think it's going to be 7.3% the next time it's released.
Well, that just saved me a question for you. So I think we agree on that. So it's supposed to increase again, what the forecasts say, correct?
That's correct.
Okay. Now, the CPI, you have what you refer in your report as 3 core measures for inflation. So those also rose. So CPI trim went from 4% to 5.1%, correct?
Well, yes, these are the Bank of Canada's measures. They don't like to look at headline CPI because it contains a lot of volatile items that are transitory. So CPI trim just trims the high and the low values. The median picks the middle value. And CPI common, I think, is what's called a principal component statistical estimate of the underlying values. So they're different measures to try and get at the core rate of inflation.
You see another example of what Maître Hamelin was referring to. I almost interrupted you there, so I'll be careful not to do it. So you agree with me that all three core measures of CPI, so trim went from 4 to 5.1, median went from 3.3 to 4.4, and CPI common went from 2.3 to 3.2, correct?
Yeah, that's the concerning event, Mr. Waller, because when you look at this, what the bank's concerned about is the temporary inflation contaminating wage increases and catch-ups on unions and things, and as a result, getting embedded in core inflation. So the concern is not the headline inflation rate, because that's really affected by foodstuffs, particularly, and commodity prices, particularly oil and gas, but it's these core measures, and it wants to stop. It just signed an agreement in December 17th, basically maintaining inflation in a 1 to 3% range.
Again, this is very interesting, but just maybe focus on my questions.
Okay. Sorry.
Now, we saw earlier that there was a policy rate increase on March 2nd, which was not referred to in your report. We saw the June 7th as well already. You do recall that there was another policy interest rate increase on April 13th of 2022. Is that correct?
That's correct.
Okay. So to be fair, that's 5 days after your report was filed. So obviously you could not have that data in your report. Now I'd like to go to document B0367. So what I'm going to show you, Dr. Booth, is a press release from the Bank of Canada on April 13th. So the second to last increase of the policy interest rate. Donc 0367. Let me know if you want me to give you time to read the document. My questions are on the last paragraph at the second page. But obviously, if you want to read the entire thing, feel free. But my questions are on just before the information note there with the economy. You see that? Just let me know when you've read the document.
Okay, that's fine. I've read this before, but...
Okay. So this is the press release that was released by the Bank of Canada when it increased the policy interest rate by 50 basis points on April 13th. So what I want to look at with you is, I'll read the paragraph. With the economy moving into excess demand and inflation persisting well above target, the Governing Council judges that interest rates will need to rise further. So that was April 13th. So obviously you'll agree with me that it wasn't a surprise to you when there was another increase in June.
Not really, and I've been on the television the last several days talking about interest rate increases and inflation. So it doesn't surprise me at all.
Yeah. Now we continue. The policy interest rate is the bank's primary monetary policy instrument, and quantitative tightening will complement increases in the policy rate. Now, the timing and pace of further increases in the policy rate will be guided by the bank's ongoing assessment of the economy and its commitment to achieving the 2% inflation target. So you do agree with me that, strike that question. I wanted to show you this press release and compare the wording with the June 1st press release. So I'll show you now document 0368. B0368. So I want to compare the language in the April 13th with the language in the June 1st. Again, in the same paragraph, the last one. Okay. So I'll just highlight with you, Dr. Booth. Let me know if you want time to read this.
No, I noticed that the words are very, very, very similar.
I want to question you on the little differences that there are. So I will highlight those for you. So what you have in front of you is the press release that accompanied the latest interest rate policy interest rate increase. So the paragraph, I'll try to make just change the document so I can read it. Okay. So with the economy in excess demand and inflation persisting well above target, and then there's new words there, and expected to move higher in the near term. See that?
Yes.
Okay. So you do agree with me that inflation is well above target, first of all?
Obviously, yes.
Okay. And you do also agree with me that inflation is expected to move higher in the near term?
Yes. And I told my students expect an overnight rate of 4.5%. That's the rate the last time the Bank of Canada tried to slow down the economy in 2007.
So presently it's at you expected at 4.5% except to achieve that on what date approximately?
Oh, I'm not going to give dates because, I mean, if I gave a date, you're going to say it occurred 5 days earlier. The problems it imposes on younger people, particularly millennials and Generation Z, who have been encouraged to buy housing. The government's given them incentives to buy housing. And a lot of them have bought houses or condominiums in the last 18 months, 2 years. And if those prices start dropping dramatically, you're going to see a lot of squealing by millennials and Generation Z. And you could generate it. There already is a little bit of a generation war between millennials and boomers like me. And I can see that would be political problems for the federal government. So we saw, for example, in Christy Friedland's comments last week that she's trying to address some of the problems of higher inflation. And in fact, she's generated, they claim, another $8-9 billion worth of spending, which for an economist just is worse. It just increased the amount of spending in the economy. But they are definitely concerned about the impact on millennials of increasing interest rates. So I think, as I tell my students, the last time the central bank tried to slow down inflation in Canada was back in 2007, and the rate went to 4.5%. At the moment, we're nowhere close to slowing down the economy. The overall demand is way too strong, and we've got so much built-up savings that you're going to have significant increases in the overnight rate. How quickly they do that depends entirely on the political implications of millennials having serious financial trouble paying for their mortgages. So it's a political, ultimately, it's the political decisions. The Governing Council of the Bank of Canada, the Deputy Minister of Finance sits on the Governing Council. So the Bank of Canada is independent, but it doesn't mean to say that there's not a to and fro between the government and the Bank of Canada.
Dr. Booth, do you agree with me that as a general rule, obviously, when we see inflation rate increasing, we also see an increase in the rate for the 30-year Canadian Treasury bond yields?
Possibly.
As a general rule, there's exceptions, but
I have here you can't see it, but I have in front of me the June 7th Royal Bank of Canada forecast. Mm-hmm. And in my view, I was hopeful that we were normalizing. And why I say hopeful we were normalizing is that interest rates would get back to normal. As I've said in my testimony, I believe anything lower than a 3.8% long Canada bond yield as being abnormal. And I was really surprised with the Royal Bank of Canada forecast, which obviously was June the 7th. I couldn't put it in my testimony, but they have the 30-year long Canada bond yield at the end of 2023 at 2.55%, which is 30 basis points less than now. So they're forecasting the long Canada bond yield is not going to get to my forecast of 3.37%, let alone the 3.8%. Their forecasting is going to go down. Now, the way that that's going to happen, if RBC is correct, is that the Bank of Canada is going to increase the short rates and we're going to have a recession and we're going to break the inflationary spiral. And if we break the inflationary spiral, we are going to bring down inflation. And as a result, long-term interest rates will come down. So when we look at inflation, it's important to separate out the transitory effects at the moment. And a lot of this is still transitory. At the time of my forecast, or time of my evidence, Bank of Canada was forecasting that inflation would come down within its 1% to 3% range within a year. They've now pushed that off to 2 years. But the most important thing is they haven't pushed it off indefinitely. They simply cannot allow inflation to stay at these sorts of levels.
But on the short term, if we look at the next 1, 2, 3 years, you do agree with me that inflation is expected to rise, to continue to rise.
I expect it to rise, and I think it's put the Bank of Canada and the federal government in a really difficult place.
Yes.
Tiff Macklem, my former dean, is governor of the Bank of Canada. He's admitted he made a mistake. The Bank of England, the governors admitted they made a mistake. The governor of the Federal Reserve has admitted they made a mistake. So all of the central banks have made a mistake, essentially, in not reacting quickly enough to stop buying bonds and to tighten, to let the bonds run off, and to increase the short-term interest rate. Because we've got all of this massive buildup of savings for the last 2 years. Now, I don't know what Montreal Airport's like, but for Toronto, Pearson is packed with people flying to Europe. They can't process them. And the restaurants are buzzing and they're full. We've had 2 years where people have been saving money, and now they're spending money. It's like you've released the top of a pressure cooker. And we've got this strong spending that's now adding to the supply side problems on the economy, which started the increase in inflation.
Okay, so with increased inflation on the short term, we can expect increasing long-term yield bonds as well on the short term, correct?
I think we may have peaked. It all depends how quickly the Bank of Canada pushes up interest rates, which I regard as a political decision rather than an economic decision at the moment, simply because higher interest rates don't affect everybody. It doesn't affect me at all, but it does affect millennials and Generation Z.
Do you agree with me that economists expect the Bank of Canada to raise interest rates again in mid-July of 2022?
Absolutely. I expect them, as I said, to really slow down the economy, we're going to have an overnight rate at least 3.5%, and it could be as high as 4.5%. The neutral rate, where they're not stimulating the economy, is about 2.5%. We're not quite sure where it is. It's guesswork, but it's about 2.5%. And we're not even at that yet. So we're still stimulating the economy.
Now, going back to the press release that we still have on the screen, we see near the bottom there, the pace. You see the sentence that starts with the pace. So the pace of further increases in the policy rate will be guided by the bank's ongoing assessment of the economy and inflation, whereas on April 13th, we did not have the words "and inflation." Okay, I'm comparing the press release from April 13th. So you do you agree with me that should higher inflation persist, Bank of Canada should tighten its monetary policy?
Absolutely. Tiff has already admitted that he made a mistake. So he admitted that he made a mistake, and now he's sort of retracing a little bit and saying, well, we're paying a lot of attention and we could be a lot quicker in the future. So that I view as just a reflection of the fact that he's publicly admitted that he made a mistake.
And tightening monetary policy is usually done through policy interest rate increase, correct?
Yeah, traditionally what we call monetary policy is all at the short end. It's treasury bills, it's short-term investments. Okay. Unconventional monetary policy is all of this quantitative easing or this massive bond buying that we've seen, which hasn't been a really big factor in Canada until COVID-19.
And you agree with me with that all else equal, higher policy interest rate equals higher cost of capital?
Now that's slipping in a different word. What's the cost of capital? It depends. If we deal with the cost of capital, when we're talking about long-term investments, we're dealing with long-term interest rates, not short-term interest rates. The only role for short-term interest rates is basically what we call working capital management, inventories. When the short rate goes up, you stop stocking inventory. You don't stop making long-term investments.
So are you suggesting we should put more weight on the long term than on the short term?
That's a crafty question, Mr. Wallet. I wouldn't say that at all.
So you don't agree that more weight needs to be put on the short term as opposed to the long term?
Are you talking about business risk or are you talking about interest rates?
I'm talking about interest rates for the time being.
Okay, fine. So in talking about interest rates, when you look at interest rates, until unconventional monetary policy started around 2010, the standard argument was when you buy a long-term bond, a 30-year bond, you're going to see a recession, a boom, a recession, a boom. You're going to see 3 or 4 recessions and booms over the life of that 30-year bond. If you buy a 1-year bond, you're only caring about what happens over the 1 year. And if you're looking at a recession over that 1 year, that's what's going to drive the yields. So long-term bonds are not as sensitive to interest rates as short-term bonds, where short-term bonds clearly are affected by the central bank policy rate, the federal funds rate in the United States, the overnight rate in Canada. That's why we refer to bond buying as unconventional monetary policy.
Now, going back to page 26 of your evidence. Je m'apprête à changer de sujet. Je ne sais pas si vous voulez continuer encore. Moi, je suis à votre disposition. Là, je peux continuer une vingtaine de minutes encore si vous voulez.
Vous pourriez terminer votre ligne de questions, puis on prendra une pause.
Parfait. Donc, je vais faire ce sujet-là, puis qui n'est pas très long, et on prendra la pause. So, Dr. Booth, I'm just going to deal with this short subject, and then we'll take the break.
Okay.
So, page 26, no, not of the PowerPoint, de son rapport, en fait, de son direct testimony. Okay. Still that same page we were on where you had the Bank of Canada data from January.
You're going to give me nightmares about this page.
I know. That's what cross-examination is all about. Huh? Let's, if we look at the end of page 17, no, I'm sorry, not of line 17, end of line 17, you see a statement here. The bank expects these other factors to stabilize in 2022 and inflation to move to slightly above the middle of its operating band of 2%. So I think we touched on this a little bit before today. So that was true at the time you wrote your report, but it's no longer true today, correct?
That's true. And as I say, it's difficult for the bank to say anything else, given the fact that it just renewed the target of 1 to 3% with a 2% middle value. So to say anything else is basically saying, well, what we just agreed to with the federal government, throw it out the window. It doesn't work. So
just to make sure we got your answer, I said that was true at the time you wrote your report, but it's no longer true today, and you responded, "That's true." So what's true?
Yes.
No, but what is true? It's true that it's no longer true?
It's true that it's no longer.
Okay.
The bank's no longer expecting inflation to stabilize in 2022. Clearly, we've got increasing inflation, and it's no longer true that the bank expects inflation to move to slightly above the middle of its operating band. That was the forecast of the bank at the time. It subsequently pushed that off for at least a year. And I suspect, to be honest, it's going to have to backtrack on that. I think inflation's going to be higher for longer.
I agree with you, and I want to review that topic with you as well. So if we could go to document, c'est le B0371. So what you have on this in this document, you're familiar with it's the Monetary Policy Report of April 2022?
I've looked at it, yes.
Okay, so again, in fairness to you, Dr. Booth, this was released on April 13th, so 5 days after your report was filed.
Okay.
Just so we're on the same page. Now, if we go to page 5 of the PDF, which is the page that's numbered 1, There, you go, you were there. OK. Page 1. On continue à monter un petit peu. Encore un peu. There we go. OK, overview. Oh, OK. And then, again, if you want to take the time to read the entire thing, let me know. My question is on the first bullet in key messages. So I'll just read this for the transcript. The outlook for CPI inflation in Canada is higher than previously projected. Inflation is expected to average just below 6% through the first half of 2022 and remain well above the control range through the rest of the year. It should then steadily decline to about 2.5% in the second half of 2023 and to 2% target in 2024. This decline reflects decreases in energy prices, a dissipation of global supply chain constraints, and a rebalancing of supply and demand in the Canadian economy. So you're familiar with that statement?
I'm familiar with the bank's view, and I think in July it'll have to retract on some of that as well.
That's exactly my point, Dr. Booth, that I want to review with you. Now, if in April, so the date of this report that we're looking at, April 13th, the bank was saying that it was expecting inflation to average just below 6% through the first half of 2022. But what we see now is, now that we're almost halfway through 2022, that inflation as it stands now is above 6%. It's 6.8% and expected to rise again on the short term, correct?
Correct.
Okay. So that's why you say they'll have to retract from that, because the data, when they increased the rates on June 1st, again, that had to change the forecast.
I think all of the, I'm not blaming, I mean, as I said, Tiff Macklin was a former colleague of mine, and he was the dean of the Rotman School. But I think Tiff suffered the same problem as the governor of the Bank of England and the governor of the Federal Reserve. They were all late. And the key thing is they thought that supply bottlenecks would clear up a lot quicker than they actually have. In fact, as you're probably aware, China keeps locking down critical cities. It's like that game at a fair when you bang the head of an animal that comes up and then another one. China just keeps locking down periodically rather than just mass inoculations. So we've got those problems that continuously come about. We've got the problems involving Russia, and there's certain critical things that Russia produces that are causing problems. But the big one is they just didn't take into account the massive amount of savings on the part of consumers and the desire after 2 years of lockdown to get out and spend. And that's going to continue for a period of time. And I don't personally think that they've got the will to increase interest rates enough to break that. In fact, I was on global television, one of our networks, a couple of nights ago, saying, I think we should seriously think about increasing the GST, because we need some sort of blanket increase in taxes, basically to break the back of inflation. And the increasing interest rates, as I say, it affects certain sectors of the economy, and it's really unfair in some sense, that it hits a particular group and not other groups, whereas the increase in the GST affects everybody.
Before we take the break, I just have a few clarification questions on what you just referred to. When you say the Bank of Canada was late in, what you mean is it was late in increasing interest rates?
Yes, very late in increasing interest rates. They should have stopped buying bonds in the middle of last year, and it should have started increasing interest rates last fall at least, and not just our bank, but all of the banks.
On that topic, you saw that last week the Fed in the U.S. increased its interest rate by 75 basis points. You saw that?
Enough.
Okay. And that was the biggest increase since 1994. Is that correct?
Well, that's correct. But you've got to remember, it's the biggest increase because we've had 2% inflation targets since 1996. So as a result, inflation hasn't been a serious problem for decades.
So just to illustrate what... Sorry, go on.
When I teach my students, one of the first things I do is ask them how old they are, because they don't recognize what us old people lived through in the 1970s, 80s, and 90s. So their perspective is not that, say, a 2.5% mortgage is a great deal. Their perspective is that's normal, and it's not normal. And they've never had significant inflation. And it's the job of the Bank of Canada and the central banks to get us back to 2% inflation. But I remember when my mortgage was 23%. And I remember when we had 14%, 13, 14% inflation in Canada. So I know what it was like before we came to this agreement between the federal government and the Bank of Canada to bring inflation down to 2%.
So just to illustrate what you're saying, when you say the central banks were late, do you recall that in 1994, Mr. Greenspan, when he had raised the interest rate by 0.75%, that was a preemptive strike, though. He had not waited for inflation to rise before he did that. Is that correct?
I think your memory's better than mine. So I can't remember that particular incident. And I'm surprised that you remember it. I didn't think you were that old.
I'm older than maybe you think. But anyhow, I'm about to change topic, so maybe it would be a good time for the break.
Okay.
And maybe just before the break, just a small comment. In all fairness, again, Dr. Willison has not modified her report. I know that she has, in her presentation, referred to updated figures in her presentation. So I understand the line of questioning of my colleague, but generally, when we file a report, and it's like that in the rate case, usually the utilities do not amend their report once it's filed. So just as a remark, as a general remark. Thank you.
Je ne suis pas certain que je comprends là, si c'est un reproche ou quoi que ce soit. Là, je comprends pas le commentaire. Je m'excuse.
I'm saying that, well, it's a general comment with respect to the filing as is, and the fact that we are answering to Dr. Willison's report, and that was not updated either. So that's a general comment I want to make.
Ça va. Moi, j'ai compris que le Dr. Willison a quand même fourni des chiffres mis à jour, mais je n'ai pas l'intention de répondre plus en détail. Là, ce serait peut-être le moment de la pause.
Parfait. Alors, merci. On se revoit à 11h10.
Merci. Can you turn to page 31 of your expert evidence? So not the presentation, but your initial report. And Madame la greffière, si on pouvait avoir la page 31 de la pièce à SIG 0037. En fait, si on regarde, ce serait le numéro de page en bas. Donc, la prochaine, voilà. Voilà. Donc, OK, juste le screenshot. So, what I want to have on the screen is, Madame, si vous pouvez descendre un petit peu juste pour qu'on voit le titre. Voilà. OK. So, what we have on the screen, what we've put on the screen is the middle of page 31 of your expert evidence. So the screenshot that we see here, Dr. Booth, that was taken from the Royal Bank of Canada's website and represents RBC's interest rate forecast on February 9th of 2022. That's correct?
Almost correct. It's taken from their monthly publication, the Financial Markets Monthly. So I actually get that on a regular basis. So okay, it's a 7-page document that I get.
Okay, so you didn't have to go on the website, you just receive it yourself, and that's an extract of that 7-page document.
That's correct. What I do is I get notification, and then I go to the web page and I download the PDF.
Okay.
So I don't get it delivered to me. I have to do something.
Okay. So I did the same thing you did to get these documents, but my point here being this one is dated February 9th of 2022, correct?
That's correct.
Okay. Now, do you agree with me, or do you know that before the filing of your expert evidence, this forecast by RBC had already been updated?
I would think it was updated sometime in March. The dates change every month, but sometime in March it would have been updated.
Almost right. So it would have been April 1st that it was updated. And what I'd like...
There wasn't a March one, but...
yeah, I didn't find one. I didn't find a March one. I got the April 1st, and I can show you its document, B0372. So what we did, Dr. Booth, while Madame is looking for the document, I took the 7-page document and we reproduced the exact same screenshot that we see in your report on page 31. So we'll show you the information for April 1st.
Are you going to show me the June 7th one as well?
Yes, I will.
Okay. Because it's interesting.
It is. Don't worry, I promise. I will show you the June 7th. Madame, le B0372. Okay, so I want to apologize to everyone in advance. We'll be looking at those small numbers for the next few minutes, and we'll go from this document to page 31 of the report to the June 7th, so bear with me. I know the numbers are small. Now, if we use this data, which was the current data as of the date of the filing of your expert report, and we look at the sentence just below the screenshot at page 31. So I don't know if you have a paper copy of your evidence in front of you. I'm just going to read right after the screenshot. What it says is, RBC is forecasting that the current overnight rate of 0.25% will increase to 1.25% by Q4 2022 and 1.75% by Q4 2023. Do you have that sentence?
I do.
Okay. Now, I just want to rewrite this with you with the data that was the most recent one as of the date of the publication of your report. So what we should read is RBC is forecasting that the current overnight rate of, instead of 0.25, it should be 0.5%, correct?
Okay, yes.
Okay. Will increase to, instead of 1.25, it should be 2%.
Yes, that's fine.
By Q4 2022, and will remain at 2% by Q4 2022. Would you agree with that? By Q4 2023.
Yes, I'll agree with that.
Okay. Now, since the filing of your expert evidence, what we're looking at now is the April 1st. There's been 2 updates to the RBC forecast, one on May 10th, 2022, and one on June 7th, 2022. You were aware of that?
Yes, I was, and am, yes.
Okay. Now, I'm going to respect my promise. I will take you to the June 7th, which will be document B0373. So you see, again, we've reproduced the exact same screenshot than what we see on page 31, but for the most up-to-date, the June 7th. Let me know if you need to take the time to review it.
No, that's fine. I've got it in front of me and I read it.
So again, we'll do the same exercise we did. We'll just reread the sentence just below the screenshot on page 31, but with the most up-to-date figures. So we should read, RBC is forecasting that the current overnight rate of 0.5% will increase to 2.75% by Q4 2022 and will remain at 2.75% by Q4 2023. That would be the correct sentence?
That's the new sentence with the new data, yes.
Yeah, well, correct if we take the up-to-date, which did not exist at the time of your report. I don't want to be unfair to you. This did not exist when you wrote this report. Okay.
I would have made a lot of money if it did exist.
How so?
Well, because I had a forecast ahead of time. If you gave me RBC's forecast for next year somehow materializing now, I'd make a lot of money trading on it.
My point is we want to know what changed since the filing of your report, and it's going well. We're reviewing this together. Now, you also write in your report just the following sentence on page 31.
Yes.
The 30-year LTC bond yield will also increase from the current 2.17% in Canada to 2.3% by Q4 2022 and remain there until Q4 2023. You see that?
Yes.
Okay. Now, my first question is on the 2.17%.
Yep.
Okay. So that 2.17%, that represents a long-term Canada bond yield as of mid-February 2022. Is that correct?
I think that's correct, yes.
Okay. Because I can't find a source for this. I don't see a footnote or a source in your report.
I think that normally is at the end of my testimony.
Okay.
Reflecting the bond yields right the way across the maturity spectrum. So I think that's
one of your schedules?
Yeah, it's in one of the schedules. So it's probably schedule 2 or 3.
I think it's 2, Canada bond yields.
That will be it.
Okay, so the 2.17 is at the very bottom of schedule 2.
That's correct.
Okay, good thing.
30-year Canada 2.17.
Okay, so over 10s, that means more than 10 years, so that would be the 30-year bond.
No, we never used to have 30-year bonds. So the over 10 series is an average of longer-term bonds that goes all the way back to 1936 when they started creating these series. But we couldn't get a 30-year Canada series because we didn't issue 30-year Canadas.
Okay. So the 217 is the forecast of the long-term Canada bond yield as of mid-February. Now the 2.3%.
2.17 was the long Canada bond yield.
Was, exactly. And I'll come to that. That has moved up, correct?
Yes, very much so.
Okay. Now, the 2.3%, the 2.30% by Q4 2022, you got that from the RBC forecast, correct?
That's correct.
Okay. Now, can we go back to page 31 of your report? Because unless I'm mistaken, the figure, and maybe I am mistaken, but you'll correct me if I'm wrong, but what you have at 2.3, in my understanding, should actually be 2.2 if we look at what was in your report on page 31.
I think that's correct.
Okay.
It should be 2.2, not 2.3.
Well, that was my.
Okay, fine. I think I've got the 2.3 is really the once we get into 2023 and says stay there. So my eyes must have wandered over a column.
No, but I just wanted to make sure that the typo is it should be 2.2 instead of 2.3. It's not that you wanted to refer to Q2 2023.
Yeah, no, that's correct.
Okay. Now, when you write, and I'm continuing that same sentence, and remain there, meaning 2.3%, until Q4 2023. So you mean remain there at 2.3. So that's consistent with just it should have been 2.3. Well, remain there because I don't understand. Is it remain at 2.2?
Well, I'm looking at the 2.3% in 2023, or at least I think that's what I was doing. And as I said, I think my eyes just wandered over and had the 2.3.
Okay.
No. So the typo really should be Q4 2022 rather than the 2.2. But regardless, I mean, I was talking about how the interest rates were going to evolve at that time. And just to sort of correct on this, I could have updated RBC But a little bit of backdrop here.
I haven't asked you a question.
Oh, sorry. Oh, no. Okay.
No, but the witness wants to add something to his answer. I think he should be adding to his answer.
Si vous me permettez, Monsieur le Président, je vais dire ça en français, puis je ne veux pas manquer je ne fais pas de reproche à qui que ce soit, là, mais le but du contre-interrogatoire, c'est de répondre à mes questions. Là, on a assisté essentiellement à une plaidoirie du Dr. Booth, alors que la régie a décidé qu'il n'y aurait pas de plaidoirie orale. Il a eu tout le temps au monde pour raconter son histoire et plaider ce qu'il voulait plaider. Maintenant, c'est le temps de répondre à mes questions. Ce n'est pas juste de partir sur une anecdote et un sujet. Moi, j'ai des questions à lui poser. Puis c'est tout simplement ce qu'il devrait faire, ce qui est l'exercice normal de contre-interrogatoire, c'est de répondre aux questions.
Monsieur le Président, il répond aux questions, mais il veut préciser sa réponse. Alors.
Écoutez, je pense que c'est le privilège du témoin de donner du contexte à la réponse à la question.
À la question.
Oui, tout à fait. Okay. Et donner du contexte aussi, pour que la réponse ait un sens.
Did you want to add something? Okay. Did you want to add something, Dr. Booth?
No, I was just going to say that I've always included the RBC forecast for as long as I can remember including forecasts. And I certainly had it in 2011 and 2009 and 2007. And the reason for that was that we were looking at the near-term forecast for an automatic ROE adjustment mechanism. But the RBC forecast, even in 2022, is only going out 18 months, basically. So if you notice, what I did add was a longer-term forecast, trying to get a handle on when we're going to get back to higher interest rates. And I put in the March forecast of the Parliamentary Budget Officer, because I was trying to get a long-term forecast. And the 2.3% I didn't think was a long enough forecast to get returned to normality. So all I was saying is I put in the RBC forecast, as I will always put in an RBC forecast, but I was really basing my estimates on the Parliamentary Budget Officer's forecast, which is a longer-term forecast. And that was, it literally came in when I was writing my testimony, which is why I inserted that in, because that was bang up to date consensus economics parliamentary budget forecast. So that's just providing a little bit of context.
Okay. Now I'm continuing to read in right where we left off at Q4 2023. As a result, the yield spread will significantly decrease from 1.43% at the end of 2021 to 0.45% by the end of 2024. So I have questions on, I just want to make sure I'm following you to arrive at those figures. I don't think it's a trick question. So I just want to have the source for the 1.33. I'll suggest to you that to arrive at 1.43, what you do is you take the 30-year Canada Q1, 21 Q4, so 1.68%, minus the 21 Q4 overnight rate in Canada at 0.25, so 1.68 minus 0.25 would be the source for the 1.43%. Is that correct?
Yes, if you found it, I will accept it.
Okay. Well, I want to make sure it's right. I don't want to mislead anyone, so I just wanted to confirm you're the author of this.
No, that's fine.
Okay. Okay. Now, and I want to do the same thing with the source for the 0.55%.
Yep.
So that would be the Q4 2003 30-year Canada 2.30% minus the 24 Q3 overnight Canada at 1.75. So 2.3 minus 1.75, that's where you find 0.55.
That's correct.
Okay. Now, and just so we're clear, going back to your report, when you say as a result, the yield spread will significantly decrease from 1.43 at the end of 2021 to 0.55 by the end of 2024, you meant by the end of 2023.
2023 Q4, that's correct.
Okay. So that's another typo we should correct. We should write 2023 instead of 24.
Yeah, all of it is referring to the end of 2020, Q4 2023. That's
okay. Okay. Now
that's the end of RBC's forecast.
Yeah, that's what I thought. I just wanted to clarify. Now, if we turn to the next page of your report, page 32, at lines 7 and 8, I'm just going to read. For the immediate future, I doubt that long-term interest rates will increase much beyond the RBC forecast. But in its 2021 budget briefing, the Government of Canada had average private sector forecast data on which it partially based its budget forecast. So that's what you're referring to, the parliamentary officer's forecast?
No, that's the budget briefing to the Government of Canada.
Okay.
So
okay,
that's
it's not the same.
Based upon the consensus, of which RBC is one of the people that surveyed in the consensus.
Okay. Okay. Now, so when you say for the immediate future, I doubt that the long-term interest rates will increase much beyond the RBC forecast. Obviously, you're referring to the RBC forecast that we were looking at page 31 of your report, the one of February 9, 2022.
That's correct. And I thought they might increase more, but not as much as they have.
That's my point. So we'll continue in that vein. So the RBC forecast that you were referring to at the time you wrote this report was 2.3%, correct?
Correct.
So I think there's no disagreement on that, but you'll agree with me that the yields on the long-term Bank of Canada bond, as reported by the Bank of Canada, exceeds now this 2.3% forecast since at least March 14, 2022. Would you agree with that? So before your evidence was filed.
I think we saw it coming up, yes. And that's why I put in the Parliamentary Budget Officer's report, which I got whilst I was doing final tidying up. And I thought this is important stuff because he's got not just because he's got a forecast, but he's got a longer term forecast. And I think the important thing on all of this is I like the RBC forecast. I used it all the time when I recommended ROE adjustment mechanisms, but it's not clear what the maturity of the horizon for the test year is for these utilities. And I don't think it's appropriate to use a short run forecast of 2022, 23, 24 yields when we've got a longer possibility of a longer term horizon before the next rate hearing.
But if the rate of return is only set for 2 or 3 years, obviously we need to look at the short-term figures, correct?
Well, you should certainly look for the short-term figures, and we're recommending, or at least my recommendation would be that they have another hearing in 3 years' time. But the last time the Gazzy Fair had a hearing was, I think I'd have to go, but I think it was 2010, which was 12 years ago. And when you're dealing with significant lag between a rates hearing and setting the fair ROE, you shouldn't be looking at a near-term forecast unless you're going to put them on an ROE adjustment mechanism, and then you automatically pick up changes in the long Canada bond yield forecast.
But if we look at only the time horizon during which the rates will be, the rate of return will be in effect, if it's only in effect for 3 years, then we have to put more weight on those 3 years, correct?
That's correct. If in fact, if it was a normal market and I didn't think that the long Canada yield was distorted because of the action of central banks, I 100% agree with you. And in fact, that was my recommendation way back in 2011 before the Americans started this massive central bank buying of bonds and messed everything up.
Can we put on the screen document B0374, B0374? This is an extract from the Bank of Canada's website. You can see there, and you see the date March 14 of 2022. And my last question to you before we went into this discussion was, I was suggesting to you that the yields on the long-term Bank of Canada bonds exceeds the 2.3% forecast since at least March 14, 2022. Do you agree with that based on this document?
Can you scroll down a little bit? So at the moment, I can see the 7-year.
Yeah, but
2.40. The over 10-year was 2.42% in March.
Exactly.
14.
Exactly.
Correct.
So based on about 3 weeks before you finalized your expert evidence, the Bank of Canada showed a long-term yield that was higher than the 2.3% RBC forecast based on February data. That's correct?
That's correct. And that's what I referenced when I talk about the March PBO forecast, which was a consensus forecast, which, as I said, I got to be able to insert it into my testimony at the last minute because I thought that was relevant, which is a longer-term forecast.
But you didn't update the other figures that you thought that were relevant as well.
The RBC has been very aggressive in their forecasts, and as I say, I don't 100% agree in their forecast. And the PBO forecast and the Government of Canada forecast, I did put on the next page, and I did emphasize that, and I built my recommendations around the Parliamentary Budget Officer's forecast. So to some extent, I downplayed the RBC forecast.
Dr. Booth, can you show me where in your evidence you warn the reader that the RBC forecast is aggressive?
Well, I did say, as you read it out to me, that line 7, page 32, for the immediate future, I doubt the long-term interest rates will increase much beyond the RBC forecast. But
that's wrong. We just saw that now it's over the RBC forecast. It's at 2.42% before the filing of your expert evidence.
But that's correct. But that's saying, I'm not saying I adopt the RBC forecast. I'm saying I'm expressing doubt about the RBC forecast because, and right now, as I told you, the June, in fact you pointed out, the June forecast is that the long Canada bond yield is going to go down. I have severe problems with that because I tend to believe that inflation is going to be more persistent than the Bank of Canada. So right now, to be absolutely honest, forecasts are all over the place about what's going on because we don't quite know. And as I've expressed, I'm not certain that the Bank of Canada has the ability and the willingness to push interest rates to a level that actually is going to slow down the economy.
So just so I understand your evidence correctly, correct me if I'm wrong, but lines 7 and 8 of page 32 of your expert evidence is your warning to the reader to be careful about RBC forecast? Well,
obviously it's not a warning in the sense that it's double capitalized, bolded warning. But I'm not saying. I mean, it does not say I wholeheartedly adopt the RBC forecast.
Okay. Now, as of now, you'll agree with me that the yields on the long-term Bank of Canada bonds, as reported by the Bank of Canada, are much higher than the 2.42% or the 2.3% that we just looked at, correct?
That's correct. They're higher than the forecast of just about everyone just 6 months ago. Nobody anticipated the inflation that we're actually getting. And Tiff Macklin, the governor of the Bank of Canada, said, I admit it, we made a mistake.
And just so we're clear, I'm not suggesting that you should have known in November what happened in June. I just don't want you to read that into my questions. Now, if you could go to document B0375. What I'm about to show you, Dr. Booth, is the actual yields on long-term Bank of Canada bonds taken from the Bank of Canada website. So I'd like to look at the 10-year and the 30-year. So we see here near the top, 10-year Government of Canada benchmark bond yields 10-year 3.27%. You see that?
Yes.
and Government of Canada benchmark bond yields long-term 3.18%. So those are the forecasts as they stand today, correct?
Well, they're not forecasts. Those are the actual yields.
Okay, I'm sorry. I misspoke. You're absolutely right. So those are the yields of the long-term and the 10-year bonds as of today.
That's correct.
Okay.
Well, as of yesterday or whenever it was, yes.
Okay, for sure. So that's, if we take the 3.27, compare that with the forecast that you had at 3.2, that's almost 1% higher.
That's correct.
Okay. Now, when you say in your report the lines we looked at for the immediate future, I doubt that long-term interest rates will increase much beyond the RBC forecast. Had you performed an analysis of some sort to be forecasting this doubt? What you said in your report?
No, that was my judgment in looking at the situation. Perhaps I should have expressed it more strongly, but I've always relied upon the RBC forecast. And as I think I mentioned, when the RBC forecast is now predicting the long Canada bond yield is going to go down, I have to admit, I don't believe that.
And you think it will continue to go up?
I think right now, I think there's more chance that the long Canada bond yield is going to go up rather than it drops down to the RBC forecast, correct. And the other part to this is what does the capital market believe? And I'll draw your attention to these yields, and they've got the Government of Canada bond yield on the long term, the 30-year, 3.18%. Can you see that?
Yeah.
And right below it has got the real yield, the yield on the real return bond, which is 1.2541%. The difference between those two is what we call the break-even inflation rate, because investors have got a choice, either buying the long-term nominal bond and getting a fixed coupon, or buying the real bond and getting compensation for inflation. So the difference between those two, which is about 1.93, is often taken as the long-term inflation rate, the long-term inflation rate in the capital market. So right now and throughout this period, we undoubtedly have this increase in inflation. The capital markets believe the Bank of Canada that they will bring down the rate of inflation. And as a result, the rate of inflation over the term of those long-term bonds is going to be around 2%, the center of the Bank of Canada's range. So that's what bond buyers are saying, and they're the people that are actually buying the bonds. They're putting their money on their forecasts. And then we've got RBCs, which is quite aggressive. And right now, all I'm saying is that in order to get that down, we've got to slow down the economy. And if you look at the yields, the 2-year bond is yielding 3.1%. The 5-year 3.18, the 7-year 3.21, the over 10 3.27, the long term 3.18. That's what we call a flat yield curve. Normally, there's a spread of about 1.25% long-term bond yields over the short-term yields. We don't see that at the moment. And why we don't see that at the moment is the bank has already pushed up short-term interest rates, and the market believes that interest rates are going to come down and that we're going to have a recession. Or at least a slowdown. Personally, I think the consumer demand is too strong, and I wouldn't be at all surprised to see short-term interest rates go up even more, an inverted yield curve, and we'll have a more serious recession. So right now, this is one of those situations where the capital markets are signaling a soft landing, and we'll get back to 1 to 3% inflation. And all I'm doing is saying that I personally have my doubts. I think there's a serious probability that inflation will get embedded in the system. And I watch the UK news all the time. Transport workers in the UK are about to strike. They've got major strikes in the UK coming out because they want catch-up. They want compensation for the 9% inflation in the UK over the last year. And once you start getting catch-up, it'll spread to other unions and other people who want compensation. And you then start getting embedded in price increases. This is what the bank was slow to react to, because once you start doing that, you have to get more serious increases in interest rates in order to slow down the economy and get that out of the system. But we're already hearing about people saying they want catch-up. And that means it gets reflected in future prices. So I think that we're in a situation right now. The central banks were late in increasing interest rates, and they're worried that it gets out of control. I've got a good suspicion that they may already have got out of the control of the central banks.
I have a question on that. Do you agree with me that it is unlikely that we'll see inflation rate back down to the 2% target before at the earliest in 2025?
I think that is probably correct. And I think it all depends, as I said, on the political will of the central bank. And the central bank is independent, but is strongly affected by government policy.
I am done speaking about interest rates, changing topic completely. I have a very, very short topic to do now, so perhaps we can continue.
Sure.
Okay,
no more typos on interest rates?
I'm sorry?
You didn't find any more typos on my interest rates?
Well, there's a few, but I don't want to do them all. We'll argue that. Now, I want to talk about the MRP and input into the CAPM. You discussed if you go to your evidence at page 50. And you'll see I'll be a lot shorter on this topic than I was on the prior one, but starting at page 50, and if you flip up to page 61 of your evidence, you discuss the market risk premium there, so those 11 pages, and you also discuss that Appendix B of your evidence. Is that correct?
That's correct.
And if we look at page 61, so that at the end of that section in your report, not in the appendices, you come up with a proposed market risk premium estimate of 5.5 to 6%. Is that correct?
That's correct.
Now, to arrive at this number, you look at a variety of sources, as we can see from your Appendix B, but the number you choose, the actual range that you use, is not taken from any of those sources. It's your own number, correct?
That's correct. It's my judgment at the moment. 2011, I think I used 5 to 6% because that's where the historic statistical data is. Canada at 4.8, US at 6.2.
Okay. Now, if I were to ask you for your calculation sheet, a mathematical calculation that would show how you arrived at your estimate of between 5.5 and 6%, you couldn't give me one. You did. That's not a calculation that you did, correct?
No, that's a judgment. I look at the historic evidence, and I look at what other people are saying. I look at what Duff and Phelps is saying, and I look at what the survey results from Fernandez is saying. If I did an average of all of those numbers, it would come out at, 5.625, which gives a spurious degree of accuracy. So if you believe the historic US evidence, it'd be a little bit outside of my range. If you believe the Canadian evidence, it would be below that range. If you believe Duff and Phelps and Fernandez, it will be exactly 5.5%. So I'm confident that that's a reasonable number.
But it's not.
But there's no mathematical calculation.
Okay, that's it. Okay. Là, I'm just going to speak French. Give me 1 second. Je m'apprête à changer de sujet qui va être un sujet un peu plus long. Ça me dérange pas de continuer jusqu'à 12h30 s'il faut, mais je voulais juste avertir la régie que si jamais vous vouliez arrêter avant, là, c'est un nouveau sujet.
Oh oui, allez-y, on peut continuer.
Parfait. Now, I'd like you, Madame Saint-Cyr, si vous pouviez mettre le document B0376. So I'll show you a document, Dr. Booth, that you will for sure be familiar with.
Never seen it before in my life.
Okay. So just before we see that it's a book called Corporate Finance, I actually have the original with me.
Let's buy it, because
I did not.
I think about 200 copies.
I borrowed it. I didn't buy it. Okay.
Oh, shame on you.
Well, maybe I'll buy it after the cross-examination. We'll see how that goes. So this book, Dr. Booth, that you authored, and I won't ask you if you're familiar with it. I take it yes, but is this the book that you use to teach your students?
No,
it's not. So what's that book exactly?
This book, the Wiley Canner people really liked our book, Introduction to Corporate Finance. And at the time, there was a lead marketing person that wanted to take our book and sell it into the United States. And it was the first book by Wiley produced in Canada that they wanted to sell into the United States. So they got Pamela Peterson Drake from a US university. I'm trying to remember the name of the university she's at. She Americanized our Canadian book. But I can tell you in all honesty, whereas Canadians are used to using Canadianized American books, Americans don't like Americanized Canadian books. And in particular, they had a competing book. And I've been to trade shows, conferences where they had all the books. Wiley never ever marketed this book in the United States. So I think we got, 200 or 300 sales. So you have a rare book. Don't give it back. It could be worth a lot of money in 20 years' time.
Okay.
Or the rest of them probably have long since been destroyed.
So your colleague Pamela Peterson Drake was at University of North Carolina. Was that or
no? She was at
or Miami.
No, she was at a university in Virginia, and it's the the name should be on the book, but
I don't think anything will turn on that, so I think we can continue. Unless you want to talk about Pamela Peterson Drake more, I don't want to interrupt you. But
no, I just felt very sorry for her because she got the contract to Americanize our book, and she reduced it in terms of chapters and put a lot of work into it, and then they didn't market the book. So, as I said, I think I probably made $300 or $400 in royalties out of it.
Okay. Okay, so can we go to page 339 of the extract? So, page 339, we see there's a subtitle beta there, and I will be reading from the last paragraph of that page. Estimating beta coefficients is tricky because we're interested in the extent that an asset's returns move with the market over a future period. We typically estimate beta coefficients by using historical data, which assumes that what has happened in the past is good predicator for the future. Typically, betas for securities are estimated by using 60 months of monthly returns, but sometimes 52 weekly returns are used. You see that?
I do.
So for the purposes of your report, you used 60 months of monthly data, 60 months of monthly returns. Is that it?
That's correct.
Now, but in this book, you also write that sometimes 52 weekly returns are used. So that's also correct.
Yes. They sometimes use daily returns.
Sometimes daily returns as well, but that's not as typical as weeklies, correct?
Well, and weekly isn't typical either. That's why it says sometimes. Sometimes people use weekly returns.
But surely, if that was wrong, you would have said so in your book. If it was wrong to use 52 weekly returns.
Oh, well, nothing's wrong in the sense of making an estimate. You can use a variety of techniques to estimate, but the data tapes that academics use are monthly returns. So it's difficult to estimate betas other than using monthly returns.
It's just I have trouble understanding why you go through the trouble of writing in your book that sometimes 52 weekly returns are used. Are they used sometimes, or are they not used? 52 weekly returns.
That sentence says that sometimes 52 weekly returns are used. They're not what I would regard, they're not standard, but sometimes people use them. And as I said, sometimes the data tapes that we academics use have monthly returns and have daily returns. They do not have weekly returns. So getting weekly returns, sometimes people have used them because the big problem is you need a lot of observations in order to reduce estimation error. So sometimes people have used 52 weekly returns, but it's not standard.
And you'll agree with me that if we were to use 1 year or 52 weekly returns, that would have the effect of increasing the betas in this case, correct?
Yes, what we do know is that the shorter the time period over which you're estimating the returns, the more likely you'll get stale data for thinly traded stocks. And as a result, they will appear to be low risk. When they're not low risk, they just haven't had a price change. And conversely, thickly traded stocks that trade frequently would tend to get high betas. So there's an estimation problem in what we call the intervaling effect. So that using 52 weekly returns is more likely to get a slightly biased high estimate for thickly traded stocks versus thinly traded stocks.
Can we go to Appendix C of your evidence, which is CSIG 0040?
Yes.
Okay, we'll just wait for Madame Saint-Cyr to project that on the screen. Okay, and it would be page 12, the actual page number. I don't know if it's the same as the PDF page. Yeah, there we go. I think we are good. So under you have a kind of a chart near the middle of that page. And then at line 10, I'll just read from the report, from your report. It's also of importance that the way these estimates are derived appears to be consistent with conventional practices. One of the biggest data providers in Canada is the Financial Post, where their corporate analyzer database includes 10-year financial data for larger publicly listed Canadian companies. Their definition of beta is, so we see that you highlight the fact that the Financial Post includes 10-year financial data, but let's read here what is the definition that you quote. Beta corporate profiles. Beta factors are derived from a historical regression of percentage share price changes from the selected company on percentage changes in the TSE 300 price index. The unadjusted slope coefficient from this regression is the beta factor. Beta factors may be computed on a variety of weekly or monthly data. Betas shown in FP Analyzer are for 52 weeks, 36 months, 60 months, and 120 months. So the 120 months is the 10-year that you refer to at line 12 of your evidence, correct?
No.
It's not.
The 10-year financial data is because they provide 10 years of like net income, sales, costs. Is 10 years of corporate financial data, not 10 years normally of beta estimates. But you can do 10 years of beta estimates if you want.
But do you agree with the definition there, which says beta factors may be computed on a variety of weekly or monthly data? You agree with that?
Yeah, you can estimate betas over any time horizon you like, and the frequency. Or like this was an issue before the Alberta Utilities Commission in 2016, and they asked me directly, does it matter whether the betas estimated over weekly versus monthly betas matter? And I said, well, theoretically, there's no difference. The risk measure, picking it up on a weekly versus a monthly versus a daily basis shouldn't make any difference. And I said, the only problem there could be thinly traded stocks. And I left it at that. And then I went back and did some research on it and found this paper by, I forgot his name, Italian name, on betas, where it tends to be that we get this intervaling effect. Gabrielle Hawawini. which is the thin trading problem. So you can estimate them however you like. The question is whether or not they're biased or unbiased in what you're trying to estimate, which is the beta. And the more frequently, the shorter the time horizon for the return, the more likely you're going to get a thinly traded stock that the price doesn't change. And as a result, it appears to be low risk. Now,
Pardon my pronunciation here, but you're familiar with Aswath Damodaran?
Your guess is as good as mine.
Okay.
I've heard him referred to as Damodaran or Damodaran. Okay. He's Indian and he's at NYU. And I referenced him in terms of the market risk premium.
Yeah. I think I just want to make sure that he's the same person that the one you referred to at page 25 of your slides that we looked at this morning.
Yeah, I think there's only one.
Yeah, well, that's what I thought.
There's a lot more than one, but there's only one famous professor with that name, I think.
Now I assume you're aware, and you're correct me if I'm wrong, but you do aware that Damodaran uses Bloomberg data and looks at 2 to 5 years to establish his betas, correct?
Well, I wasn't aware of that, but I believe you, subject to check.
Okay. But my point here, there's a variety of sources that suggest that betas can be estimated in many different ways, but you do it using 5 years of monthly data, correct?
That's correct. That is the standard way of estimating betas.
Well,
that's your way. In fact, Dr. Vilbert of Bradle, that's the way he estimated them in 2009. He estimated 5 years of monthly data for betas, and I think he also used 5 years of weekly data. So the aim is to try and find the truth rather than being doctrinaire on this.
Well, I think we're saying the same thing. There's not only one way to proceed.
That's correct.
Okay.
But there's not only one way to proceed, but as I said, the shorter the time period, the more likely the beta is going to be overestimated for thickly traded stocks and underestimated for thinly traded stocks. That's just what appears to happen, simply because they're not traded as much.
And for a stock that's not thinly traded or thickly traded?
Yeah, thickly means they're traded all the time. So as a result, the prices are never stale. But remember, the betas have to average up to 1. So if thinly traded stocks are less than 1, they're underestimated. Thickly traded stocks are the opposite. They're overestimated.
So excuse my pronunciation. I have trouble with the thin and thick here. But if a stock is not thinly traded nor thickly traded, then that would make a difference using weeklies or monthlies.
Well, true. I mean, at the extreme, you're going to get stocks that are traded all the time. And then some stocks that are never traded at all. And then you've got stocks in the middle that basically may not trade every day, but they generally trade.
Okay.
But it depends how big the stocks are.
Okay. Do you agree with me that betas are a forward-looking adjustment?
You'd have to explain what you mean. Betas are a historic estimate. It's like saying, well, yesterday's temperature was 20 degrees. It is what it is.
But are they not used to predict the future reaction of the stock?
We do use it for some predictions to determine excess returns. So, for example, if you've got a high beta stock and you want to work out how did it react to a news announcement, you need to know what was the normal expected price and then work out the unexpected price to work out the reaction. And we tend to use those, what are called event studies. We actually tend to use daily returns and daily betas because we want to know how did something react around a short window. But that's not a forecast. It's trying to sort of get an estimate of an excess return to work out how did the market respond, for example, to a dividend cut or firing the chief executive officer. Sorry.
No, I'm sorry. I didn't want to cut you. I was about to say that that was finishing this topic, but if you have something to add, by all means, go ahead.
I have seen betas used to forecast volatility and how good beta predictions are. But in all cases, when Well, let's dial back to 2006 or 2007. I can't remember what I said when Dr. Chrétien was here providing testimony, but that was just after the tech wreck, when all the internet stocks blew up, when Nortel went bankrupt and JDS Uniphase, and they brought down the Canadian stock market. During that period, the realized betas were negative. So if I came here and I said if I had come here in 2007 and said the beta of minus 0.1 for utilities should be used to set the fair rate of return, that's nonsense. It was nonsense because the realized beta just happens to reflect the circumstances of that turn. So we all adjust betas. That's not the question. The question is, how do we adjust betas?
Donc, je m'apprête à changer de document. Donc, peut-être que c'est un bon moment pour prendre la pause.
Oui, très bon moment. Alors, on arrêterait tout de suite et on reprend à 13 heures.
Je peux donner une indication aussi. Là, j'ai plus que la moitié de mon contre-interrogatoire de fait, donc ça peut donner déjà une indication là, pour la suite. J'estime que j'en ai environ pour 1 heure encore.
OK, très bien.
Est-ce que, Maître Cloutier, avec votre permission, j'ai vu que vous avez produit d'autres documents. Naturellement, je ne suis pas avec Dr. Booth, là, et ce n'est pas à sa connaissance. Est-ce qu'on peut au moins lui transmettre les documents que vous avez produits?
On pourrait vous les envoyer, Maître Hamelin, par courriel, puis vous pourrez les faire suivre, ou peut-être lui montrer sur le site de la régie où les trouver.
Oui, bien c'est ça, mais je ne voulais pas le faire parce que s'il était en contre-interrogatoire, donc je voulais juste avoir votre permission pour qu'au moins lui identifier ce que vous avez produit.
Moi, je n'ai pas d'objection, Maître Hamelin, vous avez toute ma confiance là, à lui identifier où sur le site de la régie les documents se trouvent.
Parfait, merci.
Merci. Donc, on reprend 1 heure?
Oui.
Parfait, merci beaucoup.
Merci.
So, Dr. Booth, we are resuming, waiting for lunch, and we're coming back at 1 o'clock.
Okay, I'll still be here.
And just a second, Dr. Booth, I will communicate with you to let you know that some documents have been put in the record. So I'm allowed to speak to you just to identify those exhibits to you.
Okay, so we just stay on the line and you're going to show them to me?
I can do that.
Then everybody knows exactly what you're doing.
For sure, no problem.
Merci. Rebonjour, alors nous sommes prêts à poursuivre.
Bonjour. Good afternoon, Dr. Booth.
Good afternoon.
Can you please go to Appendix C of your evidence, which is CASIG 040?
Yes.
At page 11.
Yes.
And Madame Saint-Cyr will put that on the screen for us. OK, exactement. Pouvez-vous monter un petit peu? OK, ça va, comme ça va bien. So we have around the middle of that page, we have a chart where we see 6 Canadian utilities. So these 6 companies, that's not Dr. Velatson's sample, correct?
No, these are the 3 utilities and the 3 pipelines that I've used for some time. The only addition has been Pembina because they bought Fort Chicago partners that became Verizon. Otherwise, these are the same companies I've been using for some time.
Okay, so that's your own sample.
Well, it's not so much a sample. I think the only one I could possibly have added was Ontario Hydro. It's the universe.
Okay, so it's all the companies that you use to compare the utility with.
They're the ones that I've used for a significant period of time, and okay. Obviously they've evolved over that period of time.
I just wanted to make it clear that it's not a Dr. Velatson sample that we're looking at here. It has nothing to do with Dr. Velatson, correct?
That's correct. I think Dr. Velatson adds Ontario Hydro and AltaGas, which I don't have.
Okay. Now, you have, there's a column to the right that's titled Booth, obviously, which those are your estimates.
That's correct.
Can one see from your evidence what time horizon you used for the estimations that we see there?
I normally state that I use 5 years of monthly observations.
Well, maybe in order to save time, Dr. Booth, I haven't found it. I see just over the chart, you write CFRA, Reuters, Yahoo, and the Royal Bank of Canada on January 28th, as well as my own estimates with data up to December 2021, but it doesn't say from when.
Okay, I'll take that subject to check. They are 5 years of monthly betas that I update.
What I'd like to have, Dr. Booth, as an undertaking, well, before I ask the undertaking, you have an estimation for TransCanada, you have one for Enbridge, you have one for Canadian Utilities, and we see the result, the column to the right. Does there exist a calculation sheet for each of those calculations that you made here?
Je m'objecte qu'il a déjà répondu à cette question-là. Vous lui avez posé avant la pause.
Non, c'était pas la même. C'était pas la même.
OK.
If you turn to Schedule 5 of that appendix.
Of that appendix, okay.
Yep.
Let me just get there. Okay.
You'll see that I have all the estimates for all of the companies. So, for example, in 2011, I was using Verizon in my sample, the old Fort Chicago partners, and I was using GMI. And then since then, GMI obviously is no longer publicly traded. So the estimate stops in 2018. And Verizon was acquired by Pembina, which I added Pembina.
I'm not following you. Where are you in your schedules?
Schedule 5.
Okay, that's I have one page on Schedule 5.
That's correct. And I've got the estimates for all of my companies. And those are the companies, essentially, I've been using for a significant period of time because I need long periods of time in order to assess how the risk has changed over time, if any. And I don't know whether I was asked to provide the underlying data as in answer to an information request. I may have been. Sometimes I am. And that request normally asks me to leave the way in which they're estimated in the spreadsheet.
Okay.
And I can't remember whether I was asked that this time.
Okay, well, let me see if I'm following. So we have for TransCanada, back to page 11.
Yep.
For TransCanada, first of all, TransCanada, that's TC Energy, right? That's the same
right.
company?
But I mean, not many people know who TC Energy is. It's TransCanada.
Okay. So you have 0.76 that you come up with your estimate for TransCanada. Where am I going to find that on Schedule 5?
If you look at Schedule 5 under TRP, which is the text for TransCanada, you'll find 0.76.
Okay, 0.76. I see that. So that's at the end of December 2021.
Yep. And under you see 0.97.
Okay, but I don't see. But this schedule does not allow me to see if you looked 5 years of monthly data or whatnot. Can I see that from the schedule?
No, you can't.
Okay.
And let's see. I'm surprised I didn't say it. I must have edited it out at some point in time.
Well, what I'd like to have is really I don't want
page 3.
Page 3 of
my Appendix C, where I'm referring to the utility subindex. And if you read on line 7 of page 3,
Okay, in Schedule 1 is a graph of rolling betas on Canadian utility sub-index since 1988.
that's right. And if you read on page 3, line 7, I say betas are normally estimated over the prior 5 years since the basic data sources historically used monthly data. So the first observation is from January 1988 until December 1992, and then each month as a new return is available, the 5-year estimation window moves forward a year. This process is repeated using 2 estimation techniques, and then I explain them. That's the way I estimate my betas, and I estimate them exactly the same for the Canadian securities as I use to estimate for the utility index.
Okay, so I think I think I'm following you, but I'm not sure. So let me just make sure. So what you're saying is that you looked at data up to 1988 to estimate the betas?
No, when I estimate the betas, the sub-index of the Toronto Stock Exchange was reorganized, and the current structure was pushed back to 1988. And then I estimate the betas, and then every month, as there's a new month's observation, I drop the 5-year observation and add the new one. So the beta is basically re-estimated every month going forward from 1988. So that's how I managed to get what looks like a reasonably continuous series of beta estimates.
Okay, so if the minute a new month's data comes out, you drop what is 5 years and 1 month prior, basically.
That's exactly right.
Okay.
That way you can look back over a long period of time and get an idea whether the betas are trending towards 1 or whether they're stable or what's happening.
Okay, so can I get, so I assume there would exist a calculation sheet of some sort for you to arrive at all the figures that we see in the column Booth on page 11. So for example, TransCanada we just looked at, is there a calculation sheet that will show me how you arrived at that with the precise calculations?
I can tell you, but I mean, it's estimated using the standard ordinary least squares regression. The beta is simply the slope coefficient of the return on the stock against the return on the market.
But Mike, I'm sorry.
So I've got a spreadsheet with all of that.
That's what I want.
Involved in a spreadsheet. And I thought I was asked to provide that as an information request, as normally I am.
Well, excuse me, if you did, I haven't seen it. And that could very well be my mistake, but I don't think I've seen it. And I know I haven't seen it. I don't think it's there. So what I'd like to have are the calculation as an undertaking. So the calculation sheets for all of the 6 figures that we see in the column Booth. So the one for TransCanada, Enbridge, Canadian Utilities, Emera, Fortis, and Pembina. So I'd like to have the calculation sheet to arrive at all those numbers as an undertaking. Okay, thank you.
As you can see, they'll be almost exactly the same as the Royal Bank of Canada's. But what I can do is extract that data and put it in an Excel file and provide it as an undertaking. Because that's it's one observation for each of the 6 companies, including the last year of December 2021.
Okay.
Alors, j'ai bien noté I've taken note of the undertaking. The only thing I just questioned, Dr. Booth, do you have any confidentiality issue with respect to supplying your spreadsheet?
No, none of my data is confidential.
Okay, perfect. I just want to make sure. Thank you.
Now, we see still on page 11, the column in the middle is Yahoo. You see that? Is it to your knowledge that Yahoo uses 3 years of monthly data to calculate its betas?
No, Yahoo uses 5 years of monthly data.
You're sure of that?
I'm positive about that because I was asked that in an information request and I provided it.
Okay, so I'll see that in the information request. So you have backup to show that Yahoo uses 5 years.
Absolutely. What I did was take a screen capture of one of the company's profile in Yahoo And under the beta, it had 5 years monthly data.
Are you sure that's Yahoo?
Positive is Yahoo.
Okay.
I use Yahoo all the time.
Okay.
In fact, I can pick it up right now and verify it.
Okay.
If you wanted.
Well, we'll see at the break if it's necessary or not. Okay, so we have your average at 0.74. We have your median at 0.67. But if we look at page 13 of your appendix C, lines 18 to 20.
Yes.
I'll just let Madame Saint-Cyr, yeah, we have that here. So what you say at the end of that appendix is, given the marginal increases in the, I guess you mean betas here?
Yeah, I'm afraid that constantly word changes. Whatever I write into beat.
Okay, that's fine.
Not the word that beta that word seems to recognize.
Okay, that's fine. I hadn't picked up on that yet. So, so given the marginal increases in the betas, I would therefore tend to be conservative and increase the range from 0.55 with a midpoint of 0.525, which has historically been about the grand mean of the utility betas.
That's correct.
So the betas that you use, the beta that you use is 0.525, correct?
Yes, 0.5. I've got two estimates, 0.5 to 0.55. The mean is 0.525.
Okay. Now, your report obviously does not contain any mathematical calculation to show how this estimate of 0.525 is arrived at, correct?
Well, it's an average of 0.5 and 0.55.
No, I'm not, that's not my question. Maybe I misspoke, but what I'm saying is, forget the 0.525, I'm talking about the range, 0.5 to 0.55. I don't see any calculation that brings you there. I see calculations that bring you to 0.74, to 0.67. I don't see anywhere a calculation to bring us to that range of 0.5 to 0.55. Is that correct?
Well, there's no calculation that brings me to 0.74 because that's the calculation for the average of the three pipelines as well as the three utilities. I've used a range of 0.45 to 0.55 for the betas for utilities for at least the last decade. And when I look at this, I have the estimate of 0.58 for Canadian utilities. So if you look at CUL on Schedule 5, you see that CUL is the only utility that is really a Canadian utility in the sense that it owns ATCO Gas, ATCO Electric, ATCO Pipe. It owns other things, but both Emera and Fortis have increasingly bought a lot of US operations and they've been involved in a lot of mergers and acquisitions activity. So I would look at this and say, well, the only pure Canadian utility there is Canadian Utilities at 0.58. When I look at the mean for the betas, the grand mean coming out of my beta estimation model was 0.525. When I look at the betas over the last most recent period, 2017 to 2022 on Schedule 2, the beta is 0.494, which basically is 0.5. So we've got 0.5 for the utility sub-index, the most recent beta. We've got 0.58 for Canadian utilities, and we've got 0.525 or 0.52 as the beta, long-run beta tendencies for the grand mean in Canada. So I'm comfortable basically saying the betas have increased a little bit.
Do you want me to repeat my question, Dr. Booth?
Were you asking me if I got a specific calculation?
I want to see the calculation, not for the 0.58 of Canadian utilities, not for anything else. I want to see the calculation that brings you to what you use, which is a beta in the range of 0.5 to 0.55. Okay,
well, the 0.5 comes from the value in Schedule 2, where if you look at Schedule 2
of Appendix C,
and if you look at there's two regression results there.
Mm-hmm.
And on the left is the long-run regression results going back to the overall period to 1987. And the beta there is 0.3. And the beta for the last 5-year period is 0.494.
I'm losing you. Just can you point? You can't show me with your finger, obviously, but
well, if you look at it, it's the coefficient on the TSX, which is what the beta coefficient is.
Okay.
So on Schedule 2, the second set of regression results for 2017 to 2022, the TSX is 0.494. So if you want to be precise, I could say my value is 0.494 to 0.55.
And where's your point?
If you really wanted to be precise, it would be 0.494 to 0.58.
And so your 0.58 is still is found on that schedule as well, or is Canadian Utilities?
No, the 0.58 is Canadian Utilities, because it's
But
the only
0.5
utility in Canada we've got that has not gone helter-skelter with mergers and acquisitions activity over the last 10 years.
Okay, but my understanding is the 0.58 for Canadian Utilities you actually came up with using 5 years of monthly data. Correct?
That's right, the last 5 years.
Now I'm asking you, so that's the far end of the range. I just don't see any calculation using 5 years of monthly data for various companies that brings you to that range of 0.5 to 0.55 that you're using.
Well, the 0.5, as I said, basically is the sub-utility, the utility sub-index, which is 0.494. Now, you might quibble over 0.494 and 0.5, but I regard they're not that precise. So
but the utility sub-index, that is with data going back to 1987, correct?
No. There's two. If you check Schedule 2, there are two estimates. One covering the overall period, which is to the left, and one covering the most recent 5-year period, which is the utility sub-index, the last 60 observations, and the coefficient on the TSX, which is the beta coefficient, is 0.494. So that 0.494 on the second set of results for Schedule 2, that is the most recent beta estimate over the last 5 years monthly returns for the utility sub-index of the Toronto Stock Exchange.
Okay.
So if you wanted to be absolutely precise, 0.494 to 0.58.
Okay.
But as far as I'm concerned, these things are not that precise. 0.5 to 0.55, I think, is a reasonable range, because I haven't seen a 0.58 number like Canadian Utilities for a long time.
If we look at Appendix C again, if we look at the schedules in Appendix C, there's various schedules. Schedule 1.
Yep.
So this here, you looked at data from the midpoint in 2021 all the way back to 1992, correct? That's what we see here?
It's to December 2021. It's just that the schedule has them every 3 months, I guess, to avoid putting a whole bunch of numbers at the bottom for the time period. But the last observation is December 2021.
Okay, so that would be data from 1992 to the end of December 2021, correct?
Actually, data from 1988, because it takes 5 years to estimate. So the first observation is for the prior 5-year period.
Okay.
And that is the longest period for which we've got data for the utility sub-index.
And
because Standard & Poor's reorganized it 1995 or 1996, something like that.
And your answer would be the same at Schedule 3. So it's the same set of data that we've seen.
It's exactly the same data, except that the first set of results are for the one estimate for the whole period, rather than looking at each month updating one. And the second one is for the last 5-year period, which is, in fact, the last observation in the graph in Schedule 1.
Just give me 1 second.
Okay.
Okay. Okay, I'm changing subjects. Okay. So I'm going back to Madame Saint-Cyr, vous pouvez enlever. You can take that away from the screen. So Dr. Booth, I'm going to go back to a topic that we touched upon at the beginning of the cross-examination. So since the filing of your evidence, and I'll just state a few assertions and you tell me if you agree with me. I think it's not controversial. So since your filing of your evidence, the Bank of Canada raised its policy interest rate from 0.25 or 0.5, depending on the date you look, to 1.5. You agree with that?
Correct. Correct.
Now, the market is expecting that the Bank of Canada will raise the rates again, possibly as soon as next month, correct?
Correct. Probably 0.75%.
Probably not 0.75. You're suggesting
0.75%.
Okay, so 75 basis points.
That's correct.
Okay. And as you are aware, the Federal Reserve raised its federal funds rate by 75 basis points last week as well.
That's correct.
Now, the inflation rate went up to 6.8 from 5.1% at the time of the writing of your report.
That's correct.
The RBC
go to 7.3% or 7.2, something like that.
Yeah, well, it's going up when we know it's going up again in July. Yeah.
Yes.
Now, the RBC forecast for the overnight rate doubled since the filing of your report, so from 0.25 to 0.5.
Yes.
The RBC forecast for the overnight rate as of Q4 2022 also doubled, going from 1.25 to 2.5%.
Sorry, say that one again?
Yeah, I'm sorry. Yeah, that's a lot of numbers. So the RBC forecast for the overnight rate as of Q4 2022 doubled also.
Yes.
So from 1.25 to 2.5.
That's correct.
Okay. And all these changes that happened since the filing of your report have had zero impact on your recommended ROE of 7.5%, correct?
That's correct, because the Long Canada forecast hasn't reached my trigger point of 3.8%. We're still in a period of very low Long Canada rates, and the base for the fair ROE in Canada is the forecast Long Canada rate.
And I think we've established that you expect the 3.8 to be reached in the near future, correct?
I didn't say that. I did expect it, and then RBC came out with this forecast that they expected to go down. It's entirely contingent upon the success of the Bank of Canada slowing down the economy and bringing down interest rates. And right now we're at a period where it's not at all certain that the actions of the central bank are enough to slow down inflation. I'm skeptical. RBC seems to be more optimistic.
And your opinion is that the 3.8 will be surpassed in the near term?
I hate to be technical. Define near term.
Well,
I think,
in the coming 2 years.
I think we're going to get very close to it. I don't think we're going to get past it. And the reason for that is that currently the forecast is about 3.36 by the Parliamentary Budget Officer, but that includes the 37 basis points for the Long Canada over the 10-year rate. And right now, there is no premium of the 30-year over the 10-year rate. In fact, the 30-year rate's less than the 10-year rate. So effectively, we're at the 3% forecast now. Do I see an 80 basis points increase? That would mean that the Bank of Canada has not been able to control inflation and the demand has been overwhelmed, the willingness of the Bank of Canada to increase interest rates. And that comes down to what on earth the government of Canada is saying to the Bank of Canada about the political implications of rising interest rates. If we're in the United States, Biden's facing his interims in November, and politically, the Fed is under a lot of pressure not to increase interest rates too much, because you trigger in a recession and high inflation just when the government's got an election, the Democrats are going to have a serious problem with the midterms. So there's obviously a political element to all of this.
Can we please go to page 46 of Dr. Booth's evidence? So CSC 0037.
Yes.
Okay, I'll just wait for Madame Saint-Cyr to put that on the screen. So it's la page 46 de CAC 0037. Voilà, le tout en haut complètement. At the very top of the page, 46. There we go. Okay. So the question you were asked is, how would you compare conditions now versus your 2011 GMI report? And your answer is, I would say that in many respects, they're quite similar. So that is what you wrote in, I think it would have been early this year, early 2022. So you're still of the opinion that the conditions now are comparable to 2011?
Now I'd have to. I'm not sure that I said that we were further along in the business cycle than we were in 2011, because it's the story of the clock that says 2 o'clock twice a day, but it's completely different. One time it's in the afternoon, one time it's early in the morning, and that's the business cycle. I think a lot back in 2011. As I said, we were waiting for Godot. We were waiting for the Americans. We'd recovered, and it was like, come on, Americans, get your act together. Start growing. Start increasing employment. And we waited for the Americans for several years. Now, we're at the other stage. We're not at the early stage of the business cycle. We're at the late stage of the business cycle. So a lot of the indicators are exactly the same in terms of capacity indicators, for example. The break-even inflation rate's a bit lower. CPI is definitely higher. The unemployment rate, you never mentioned that one. The unemployment rate was 6% when I put my testimony together. Now it's 5.1%. This is literally unheard of. It signifies we've soaked up all of the excess labor in the Canadian market, and we're short of people. All of these indicate late cycle for the business, for the economy. And as a result, the central bank slowing down the economy. But you're absolutely right. A lot of them, as I said, are very, very similar. The position of loan officers, the stress indicators, credit spreads are sort of similar. The major factor is the long-term Canada bond yield. And otherwise, if we hadn't had this 13 years of bond buying by central banks, and interest rates were where they should be, 3, 4, 5%, I would say it's very similar to 2011, okay. Except that we're on the down instead of on the up.
So I'll ask you several questions on what I suggest are differences between the market now and the market back in 2011. Obviously, things can change in 11 years. But you're aware that the rate of return that was set for Énergie, as it was known, Gaz Métro back then, was 8.9% in 2011. Correct. Okay.
And that was a 30 basis points spread over the 8.6, I guess, which was the generic ROE.
So what you're suggesting to the Régie is that despite similar market conditions and a similar risk, the rate of return should decrease from the actual 8.9% to your recommended 7.5% rate. Is that your suggestion?
I think the correct suggestion is that I made a recommendation in 2011. I think it was 7.75%. And my recommendation now is 7.5%, which is slightly lower. Nowhere near as much as the decline in the long Canada bond yield, but it's slightly lower. And I would say at the moment, the 8.9% is slightly higher by about 25 basis points. But I'll remind you, I think it was 2 years after the 2011 hearing, the lawyer for IGU at the time called me up and talked about the settlement. And
said, you can't talk about privileged information. I mean, you can say what you want, but privilege is something protected by our Constitution, so be careful.
Okay, I won't say another word, okay? But I mean, I have no problem with the fact that independent of any settlement, I have no problem, since I've said specifically on so many occasions that my 7.5%, I would not lower it because of lower interest rates, and I would not change it until the long Canada bond yield got to above 3.8%, and the conditions in the bond market started to become normal. That is, that they're established by ordinary people, not the central banks. So I would say that the regime got it right, basically, given the fact that a little bit higher than I think is reasonable, but keeping it the same, I think, has been perfectly reasonable.
Now, this is probably my easiest question since the beginning of this cross-examination, but you'll agree with me that in 2011, there was no global COVID-19 pandemic.
That's correct.
Okay. And you'll agree with me that the inflation rate back in 2011 was not nearly as high as it is today, correct?
True, but we're looking at the long-term inflation rate. And I'll draw your attention to the fact that in July 2011, the break-even inflation rate was 2.51. Now it's 1.8%. In both cases, they're within the 1% to 3% range.
Do you recall?
There was no COVID, but we have had SARS, and we've had fears of other sorts of pandemics.
Well, sure, you're not going to compare SARS to what happened with the COVID-19, correct?
Of course not. But I'm saying that at the time we were worried about SARS.
Okay. But now we're not just worried about COVID-19. It happened. We've been living it for over 2 years now.
Oh, absolutely. Correct? And in fact, word's out that there's yet another variant of COVID-19, and Europe's bracing for another round of infection, because this seems to be an extremely infectious disease.
Do you recall that the GMI hearing, if I may call it that, in 2011 took place in September, just so we know when the hearing took place? September 2011?
I will accept that. I can't remember exactly when it was.
Well, I can tell you it was from the 7th to the 23rd of September 2011. But the purpose of this is, do you agree with me that back in September 2011, CPI inflation stood at 3.2% versus 6.8% today?
I will accept that. Obviously, my memory, as I get older, days merge, years merge, and I can't remember exactly what the rate of inflation was at a particular point in time.
No, I understand that. I understand that. But I've put a document. We've put in the document, which is B0377, if you want to have a look at it.
No, I'll accept that subject to check. It might have been, that must be the headline CPI rate rather than the core. Yeah.
I'll give you all the data. So CPI, total CPI 3.2, CPI trim was 2.1, CPI median was 2, and so was CPI common.
Yeah, so all three of the core ones were well within the 1% to 3% range. So clearly there must have been, I'd have to remember whether that was commodity prices causing problems. But I mean, the problem in Canada is that the oil and gas prices have a reasonably big impact.
Yeah, but these inflation figures are way different than they are today, correct?
Oh, that's correct. There's no question about that whatsoever. The question is whether it's permanent or whether it's transitory, and whether the Bank of Canada can get a hold on the second stage when it drifts into wage increases and underlying inflation.
Now, do you agree with me that labor shortages were not as present in 2011 as they are today?
Mr. Willett, we always thought of 6% as the lowest the unemployment rate could go in Canada. Anything below 6% we called NAIRU, the non-accelerating inflation rate of unemployment, which meant that if unemployment got below 6%, we'd get inflation. And now we've got 5.1%. So I can't remember how many decades you have to go back to find an unemployment rate in Canada of 5.1%, but it is a long, long way.
So just so it's clear for the record, for the transcript, you do agree that there were no labor shortages as much, or there was not as much labor shortages back in 2011 than there are today?
Absolutely correct.
Okay. And same question with regard to supply chain bottlenecks. That was not as present in 2011 as it is today, correct?
I think we'd never heard of it at that time because everyone was talking about how efficient the supply chains were. Okay. Now we've discovered how critical China is.
And another obvious one, but back in 2011, there was no war in Ukraine causing the imposition of global economic sanctions against Russia.
That's correct. I'm sure there was a war somewhere, but obviously not as important as war in Eastern Europe.
Now, I'd like to quickly discuss the standalone principle. You're familiar with that principle?
I am.
Can we go to your direct testimony? So, CASIC 0037, page 101.
Yes.
Okay, and I'll just read for the record. So, question, I'm at line 15.
Yes.
Okay, page 1, so just next page. Un petit peu plus bas encore. Voilà, à partir de la page de la ligne 15. So I'm going to read starting at line 15. So there was a question. Doesn't the isolation principle justify Gazifère's higher common equity ratio based on its small size? I'll read the answer. No, the isolation or standalone principle is justified based on a holding company or sister company charging uneconomic costs to the operating subsidiary. For example, prior to the PUHCA in the U.S. electricity companies owned unregulated electric tram, streetcar companies and apparently were charged uneconomic prices by the regulated electric companies. After the passage of the PUHCA, these streetcar operations were divested and many of them went out of business. The point is that standalone was meant to mean that the charges to the utility were fair and reasonable, not that a small uneconomic subsidiary should remain in business protected by regulation. In this respect, Gazifère is an artificially small business and seems to be integrated with EGI. Note, Gazifère pays Enbridge interest based on BBB low bond rating when EGI is the strongest gas distribution utility in Canada, covering almost all of Ontario. I regard this as charging uneconomic costs to Gazifère. So you still agree?
Ratepayers.
Yes. So you still agree with that answer that you gave?
Yes, I expected questions on this because I'm fully aware that the REGI regulates a legal entity called Gazifère, and it has to do that according to regulations in Ontario. But as an economist, Gazifère seems to be integrated with Enbridge. And I say seems because I asked a series of questions on this, and they refused to answer. So I went to Enbridge's annual information form to see what Enbridge talks about Gazifère, and all I could find was that the senior executive in charge of Enbridge is also in charge of Gazifère. And
so Dr. Booth, I know you expected question on this. Maybe we can wait for my questions before you start answering them.
Sorry.
Okay. Thank you. So you heard Jean-Benoît Trahan, his evidence. Did you hear his evidence from Gazifère?
No, I didn't.
Okay. Now, you did not hear Mr. Trahan explain that Enbridge and Gazifère operate independently from each other.
Isn't he the senior executive in charge of Gazifère?
Yes, he is in charge of Gazifère.
So I'm not surprised that he would say that, yes.
So, but you weren't present during his testimony, correct?
I wasn't. I do know him from previous work, but...
Do you recall, so you're not aware that Mr. Trahan explained that Gazifère and Enbridge are subject to different legislative and regulatory frameworks? You agree with that?
Subject to different regulations within Ontario versus Quebec, of course.
And obviously subject to different regulators?
And different regulators, yeah.
And they serve...
Sorry.
I'm sorry. Okay.
And they serve...
Okay, go ahead.
No, it's all right. Carry on.
Okay. So you're aware that they serve clients that have different consumption habits?
Well, you mean that the regulator, the clientele of Gazifère is not the same as the clientele of Enbridge?
Of Enbridge, yes.
But, Enbridge gas distribution in Ontario used to be very much a residential. In the purchase of Central Gas Ontario in Northwest Ontario and Union Gas, it acquired a much bigger clientele of industrial users, pipeline assets, and storage assets. So the composition of Enbridge gas has changed as a result of acquisition, whereas Gazifère, as we know, is primarily a residential utility.
I'd like to put before you, unfortunately, I don't have the Régie exhibit, but it's EGI 52.6. It's a 2010 decision, D210-147. I'll try to see if someone can help me with the Régie quote. So it would be B0384, B0384. So what I'm going to put before you, Dr. Booth, is the Régie decision in the 2010 Gazifère case, in which I believe in which you testified, correct?
I did, and I'm fully aware of the decision of the Régie in terms of the isolation principle.
Okay, so we'll look at that together. Donc, c'est le B0384. Unfortunately, Dr. Booth, I don't think we have an English version of that. So what I'll do is I will translate, and if Maître Hamelin can correct me if she does not agree with my translation.
I think we have an official translation of that decision. So
great, even better.
Just
okay.
Check.
Yes. That would obviously be better than doing the French.
If you give me 5 minutes, I can.
No problem.
2 minutes.
Okay, so if we could.
Sorry.
Okay, is this the English one or it's the French one?
This is a French one, and
okay.
I have, it was not, the English unofficial translation was not filed, but I have it in front of me, so.
Okay, do you want to, maybe we can just, we'll use the English, but maybe we can file it afterwards, just so everybody has that. But Maître Hamelin, if you could just email it to me and to Dr. Booth, and we'll both have the same thing. We can read from the decision and then perhaps file it in the record. Si ça vous convient, Monsieur le Président et Mesdames les régisseurs.
Oui, ça va, merci.
Parfait. Donc, je vais juste laisser le temps à Maître Hamelin de me l'envoyer par courriel. Je vais fermer mon micro, puis je vais prendre la décision.
Alors, je viens de l'envoyer. Je ne sais pas s'il y avait des annotations là-dessus parce que c'est ma copie. Alors.
S'il y en a, Maître Hamelin, je vais les ignorer. Là. Je regarde 2 paragraphes seulement. Ce sont les paragraphes 158 et 165.
Ben, ça nous intéresse.
Have you received it, Dr. Booth? I haven't received it yet. OK, je l'ai.
Yes, I've got it.
OK. So I will go to paragraph 158. Il y a du jaune, Maître Hamelin, je le constate en faisant le scroll down.
je pense que les paragraphes dont vous faites référence, il n'y a pas de... De toute façon, vous allez les lire si ma compréhension est bonne.
Oui, exact.
Alors, on verra produire une version
Ça va.
clean.
Donc, m'y voilà. Okay, so I'll start by reading the unofficial translation of paragraph 158, Dr. Booth. So, according to Dr. Booth, if there were no provincial boundary, Gazifère's assets would not be distinct from Enbridge's, and the two would be integrated. On this basis, and in view of the economic principle that similar assets should generate equivalent returns, Gazifère should have the same capital structure, the same cost of debt, and the same rate of return as Enbridge. So you recall that was your position back in 2010, Dr. Booth?
Well, I can't remember the exact words and whether that reflects exactly what I said, but I'm happy to see that my view hasn't changed in 13 years. And I'd say that I was once asked in a BC Utilities hearing by the opposing lawyer. He gave me a question and I gave the same answer. And he said, well, Professor Booth, 3 years ago, I asked you the same question and you gave the same answer. And he went back to something like 9 years earlier. He asked me the same question and I gave the same answer. So in substance, my view is simply that
I haven't asked my question yet.
Sorry, sorry. Well, I thought you asked me whether I agreed with that or it was the same.
My question was that your evidence, your position back in 2011?
I would assume
2010. Sorry.
I mean, I can't remember exactly what I said, but as I read it, I would not disagree with that now.
Now, at paragraph 165, I will just read the Régie's decision here. The Régie has long established Gazifère's cost of debt on the basis of the standalone principle. The Régie finds that the evidence does not support a change in this approach. So do you recall that the Régie did not agree with you that Gazifère should be viewed as the same as Enbridge?
That is exactly why I expected cross-examination on this.
Okay, so despite the Régie not agreeing with you back in 2010, you're presenting the same position, correct?
The underlying economics haven't changed, but as far as I can see, the person running Gazifère is also running Enbridge Gas, the whole of the utility. So clearly it's a separate legal subsidiary, but my view would be that the isolation or the standalone principle should not trump fair and reasonable rates. And the question that we should ask is if in fact Gazifère is integrated with Enbridge, as I strongly suspect it is, but I couldn't get any answers out of Gazifère on this. If it is really integrated, how really significantly different do you think the Gazifère assets would be from, say, Scarborough in Toronto, which is Enbridge gas distribution, or anywhere else where it's predominantly residential and serviced by Enbridge? There may be some of these new risks that we've yet to work out how they actually manifest as an inability for Gazifère to earn its allowed ROE. But we're talking about part of what I might term Greater Ottawa in terms of, is that substantially different? Enbridge serving that component versus serving another part of, say, Greater Toronto. And I would believe that the fair and reasonable standards should mean that that should trump. You should look beyond that. And there's a phrase that we use all the time in legal decisions, piercing the corporate veil, which is to say looking beyond the legal entity of Gazifère to the substance of the transaction. And that's all I'm saying here, that from what I can see, Gazifère seems to be integrated with Enbridge. And I'm not quite so sure why it should be charged a triple B rate on its debt when that debt's coming from an entity which is way better than a triple B debt and has got one of the lowest cost of debt of any utilities. So I would say that was charging Gazifère's customers almost certainly probably an unfair cost of debt, and the rates probably are unfair and unreasonable as a result. But I fully recognize that the Régie has a responsibility to regulate a separate legal entity in Quebec.
Okay, so I just want to, I have a few clarification questions on that. So your position that you just explained, it's the same position you had in 2010, correct?
Well, I can't remember word for word what I said in 2010, but I think in substance it's the same because the economic position of Gazifare hasn't changed.
But Dr. Booth, my point here is that you've been very, very critical of Dr. Villaton in your direct evidence when she brings an argument that was dismissed by the Régie at the latest hearing. So am I to understand that when you do the exact same thing, that's correct?
No, that's a misrepresentation, I would say. What I'm saying here is that the Régie should look at fair and reasonable rates and basically look at Gazifare and say whether the underlying functional role of Gazifare within Enbridge means that the rates should then be unfair and unreasonable. On the other hand, when I'm looking at Dr. Villaton, she's doing things that are unacceptable to me as a finance professor, and I would say that in the strongest way, they're unacceptable. Adjusted betas, there is no statistical evidence for adjusted betas for utilities. I've never seen any study that's looked at utilities and said they should adjust their betas towards 1. And I've never seen anybody use the empirical capital asset pricing model in the way that Dr. Villaton and before her, Dr. Wilbur used them. And the way in which she uses the APWAC, using market values fixing with book value weights, was described by the AUC that they'd be derelict in their responsibilities to accept that.
So Doctor,
so I'm just you asked me about this, and
I did.
These are unacceptable. I'm sorry, I can't say anything else.
So
and I was warned by counsel to be very friendly and not be provocative, but to wearing my professor of finance hats, these are unacceptable. Whereas all I'm saying to the Régie is I fully recognize legal responsibilities to treat Gazifare as a legal entity, but there is also piercing the corporate veil and the responsibility to have fair and reasonable rates, which trumps, I think, the isolation or the standalone principle.
Are you aware, Dr. Booth, that piercing the corporate veil in Quebec can only be done in cases of fraud, contravention to rules of public order?
I wasn't aware of that in Quebec. I was aware that it happens all the time before Canada Revenue Agency.
But you're surely not a specialist in piercing corporate veils, correct? You're not a legal specialist.
I'm absolutely not. I've said many, many times I am not a lawyer. I am not licensed to practice law. What I am is a professor of finance that deals with contracts all the time that have got legal implications.
So if I understand your testimony correctly, what we should take from your evidence is that the Régie set an unfair and an unreasonable rate of return for Gazifare in 2010.
No, I'm not saying that at all. I'm saying that the standard is fair and reasonable rates. And that trumps, in my opinion, the standalone principle or the isolation principle. And I'm sure the Régie set what it felt was fair and reasonable rates. And just to reflect on this, I'm recommending for Gazifare a 40% common equity ratio, which is more than a smaller utility in Alberta gets, which is 39%. So it's not as if I'm being saying they should have Enbridge's 36% allowed return. So it's not like I'm sort of being particularly hard saying give them exactly what Enbridge gets. But I would just point out to the Régie the overriding criteria is fair and reasonable rates.
Can we go to page 98 of your report, please?
Yes.
So we'll ask Madame Saint-Cyr to put that on the screen. I'm almost done, Monsieur le Président. A few more minutes. Donc la pièce, la même pièce, le témoignage en chef du Dr. Booth, la page 98. Je crois que c'est 0037. Donc la prochaine page, je crois. Voilà, et c'est en haut ici. So I'm directing you, Dr. Booth, to starting at line 3.
Yes.
Okay. The question was, are you saying that climate change is not a risk factor that has increased risk for the Quebec utilities? And I'll read your answer. No, I am simply pointing out that all provinces must try and reduce the use of fossil fuels and their impact on climate change. However, the tools available to them to do that are different given different energy endowments. According to the Premier, all of the states and Canadian provinces, according to the Premier, of all the states and Canadian provinces, Quebec emits the fewest greenhouse gases per capita. In this respect, Quebec is exceedingly lucky, similar in some respects to BC and Manitoba, in having significant access to low-cost, cheap electricity. As a result, reducing the use of natural gas is higher up the priority list. So you still agree with that answer, Dr. Booth?
Yes, it's Quebec is extremely lucky. It's when I think of the nuclear plants that we've got in Ontario, because we've used up all of the Niagara generated hydro. We don't have the luxury of cheap cost electricity. So to people in Ontario, natural gas is not the best choice, but it's better than burning coal and better than burning oil. And we've talked a little bit about Ukraine and Europe. They're dying for gas. They're building new liquefied natural gas facilities because they want to get off Russian gas, and they still want to they still treat natural gas as a halfway fuel. So when we look at the provinces, every province wants to do the right thing. When Quebec turns around to do the right thing, what it regards as the right thing is in fact something in other provinces that they regard as the best thing that's available. And when you look at this, climate change is a global phenomenon, and it's something that everybody has to deal with. The best way, with my economist hat on, of reducing climate change is to stop the Indians and Chinese using low-quality coal to burn for electricity. So it's much better that we reduce greenhouse gases by getting India and China to reduce pollution than it is for Quebec to shut down natural gas. So I know every province is different. Every province has a legal requirement and they've got political agenda. But with my global economy hat on, I'd say the best possible solution is for Quebec to pay China not to pollute, because a ton of greenhouse gas is the same no matter where it's produced.
Okay, so let's leave China and India aside and stay in Canada for now. So
okay,
you
stop
agree?
Alberta burning that. So stop. Well, we are stopping Nova Scotia, but Nova Scotia has still got coal plants.
I have a question at some point.
Okay, sorry.
Okay, so Dr. Booth, you'll agree with me that the situation's not the same in every Canadian province in terms of climate change.
Yes.
Okay. Now, last Friday, you suggested that long-term risk is relevant when there is evidence that such risk will prejudice the shareholders' return on investment. Do you recall that part of your testimony?
I don't. I was probably thinking of Trans-Canada Main Line, where long-term risk was reduction of its load because people were dropping off the system, and it was a quantifiable reduction in load that had implications for the main line. And that was long-term because the long-term contracts were not being renewed.
Are you aware, or can you point me to any regulatory principle or author who would confirm that long-term risk is relevant when there is evidence that such prejudice that it will prejudice the shareholders' return on investment?
No, I can't remember whether I said exactly that, but if I didn't say exactly that, what I meant was long-term risk has to become short-term risk. It has to affect the ability of the utility to earn its allowed ROE. And just saying, well, there's risks out there in the future, and there's always risks out there in the future, isn't enough. You show how, and I'm pretty sure I said where the rubber meets the road. When we had this in before the National Energy Board, the long-term risks were definite. We could see the throughput forecast for the Trans-Canada Main Line, and it was going to have problems with a lower load, rebalancing rates to make sure that people stayed on the system. Okay. So in that sense, the long-term risk was quantifiable and affected the recovery of the main line's cost. So in that sense, it was quantitative. You could look at it and it was definite.
But my question to you is, can you point me to an author or regulatory principle that says that long-term risk is relevant only when there's evidence that the shareholders' return on investment will be prejudiced?
Well, that's common sense. If the long-term,
I'm asking you if you can point to an author or book or principle that says that.
Risk.
You can.
Okay. Well,
you have to answer my question, and then you can explain that it's common sense. But first, can you answer my question?
No, I can't, because it's obvious. And it's obvious because risk reflects two things. It reflects the situation and your exposure to that risk. If the risk occurs and there's no harm, your exposure to that risk is negligible, then it's not a material risk. It has to affect the investor. I talk to my students about, suppose a bond defaults. If the bond defaults and you get 100% of your money back, then there's no risk. So the probability default doesn't have an impact. It has to have a probability of something happening and a cost to that incident. And if something happens and there's never a loss to the shareholder, it's not a risk. And that's just logic, I would have thought.
I have one last topic that I'd like to address with you, Dr. Booth.
Yep.
I will show you, if Madame Saint-Cyr could put on the screen exhibit R-4358. So you'll see, Dr. Booth, it's a chapter in a book that you authored.
Est-ce que c'est B0378?
Oui, j'ai dit R. Hein, mon R a l'air d'un B, mais c'est B, oui. Je m'excuse. So, this is the cover page of the book, but if we want to look at your article, we have to go to the next page. It's an article titled The Cost of Equity Capital and the Fair Rate of Return on Equity for a Canadian Utility.
Yes.
So you authored, obviously, this article.
True. It's, I think if I remember correctly, Gordon Kaiser wanted something from me and something from Kathy Shane, just to give the opposing views on the cost of capital.
Okay. Now, this was written in 2011, correct?
Well, I will accept that. I can't remember exactly.
Well,
but probably.
Just to be transparent with you, I took the book and I looked at the book and it says copyright 2011. So that's where I got my date from.
2010.
Okay. Now, if we go to page 487 of the chapter that we've put in the record, talking about Canadian utilities. 487. Voilà, et plus bas, un petit peu plus bas. Okay, so you see, maybe we'll make this bigger. So just before Fairness Revisited, you write in 2011 or 2010, overall, I continue to use a beta estimate of no more than 0.5 for Canadian utilities, which means that 250 basis point utility risk premium. If this is added to a flotation cost allowance of 0.5% and a forecast long Canada bond yield, the fair ROE for a Canadian utility is about 7.5%, which is less than the current formula AROE.
Allowed ROE.
Yeah. So Dr. Booth, and I think you touched on this during your direct examination as well. So basically, what I understand from that is your recommendation for a benchmark utility in Canada is 7.5% ROE, correct?
That's correct.
And it has been so. This was written in 2010, so 12 years ago, and your recommendation for the benchmark utility has not changed. It is still 7.5%, correct?
That's correct. And when you look at it, the beta estimate I got there is no more than 0.5. That was in a range 0.45 to 0.55. I've now increased it slightly, 0.5 to 0.55. But the flotation cost is the same. The main feature of that is the long Canada bond yield. And I don't believe the long Canada bond yield is now a fair reflection of the opportunity cost for somebody trading off bonds and equities.
But the underlying financial data changes, but that has no effect ever on your result. It remains at 7.5, no matter the interest rate, no matter the inflation. It'll always come up to 7.5, and that's been the case since 2010, correct?
You can thank the government of Canada for that.
Okay, but the answer is yes?
The answer is yes, as long as, ever since 1996, when the government of Canada and the Bank of Canada agreed to a 2% target rate of inflation, we've had a dramatic reduction in the uncertainty, the inflationary environment, bond yields, the market risk premium, and that's reflected in the capital markets. It's been reflected in the information, for example, Duff and Phelps. When I put up Duff and Phelps' estimate of the overall market return, you have to go back 15 years to get something above 10%. Otherwise, the overall market return's in a relatively narrow range. We're no longer in a situation the way we were in the 60s, 70s, 80s, and 90s, where the allowed ROE has fluctuated significantly. We were in a very stable environment up until these dramatically low long-term bond yields. And I'm not going to change my view until we see a long Canada bond yield above 3.8%. So if we have another hearing in 3 years, Mr. Ouellette, you can ask me all exactly the same questions, because unless the long Canada bond yield has exceeded 3.8%, you can say, aha, Dr. Booth, you said you weren't going to change your opinion unless the long Canada bond yield was above 3.8%, and it's still below 3.8%.
So basically, if I understand you correctly, as long as the long-term yield is below 3.8%, there's no use for rate of return hearings. It's just should be 7.5, nothing changes, no matter the interest rates.
The regime hasn't changed the allowed ROE for Energia since 2011. So I would say the regime agrees with me as well.
No, but we're doing this hearing now.
Well, that's true, but you have to do it periodically just to have an evidentiary record that either something has changed or something hasn't changed. So you can't just go on forever unless the companies generally ask for a rate hearing just to make sure everything is fair, or the board or the regime brings companies in to make sure everything is fair. But
just to speed things up a little, during the lunch break, did you have a chance to look at the documents that we have put in the system?
No, I thought you were going to present them to me and ask questions.
Well, then, okay, so let's forget about speeding things up. So you tell me if you need to review the documents, but we've put in the system, the SDE, your reports from other testimonies elsewhere in Canada and your recommendations. So first off, we can put it on the screen if necessary, but let us know if you want to see it. I'll give you my questions, and perhaps you'll agree and we won't have to look at the documents.
Okay.
So do you recall you testified in the fair return hearing for Fortis BC Energy in 2012-13?
Yes, that's almost 10 years ago. But,
I know.
Yes.
And your recommendation for Fortis BC Energy was an ROE of 7.5%, correct?
Doesn't surprise me, yes. I'll accept that.
Okay. Now, going to 2016 in Alberta, there was a generic return on equity and common equity ratio hearing for ATCO pipelines. And in that hearing, in which you also testified, your recommendation was a 7.5% ROE, correct?
That's correct. And just to correct you, these are generic recommendations. They're not specific recommendations for a particular company. They're the generic based upon the capital structure being adjusted for business risk and the generic ROE being a base for ROEs for other utilities. So, for example, in the BC Utilities Commission hearing, it was for Fortis BC Energy, knowing that other BC utilities would get premiums on top of the generic ROE or the benchmark ROE.
But my suggestion to you was that for ATCO Pipelines, it wasn't the benchmark ROE. Your suggestion was 7.5% ROE for ATCO Pipelines on a 30% common equity, correct?
But it was a generic ROE hearing. So that was a generic ROE.
Okay. Now, 2016, British Columbia, in the fair return and capital structure hearing for Fortis BC Energy, your recommendation again was 7.5% ROE.
That's correct. Now,
that's correct.
But the 2012-13, I'm pretty sure there was an automatic ROE adjustment mechanism involved as well. And I recommended an automatic ROE adjustment mechanism. And I think I also recommended that our automatic ROE adjustment mechanism only varied if the forecast long Canada rate got above 3.8%.
Okay. Now, 2018.
Other elements to the decision.
Okay. Now, 2018, Labrador and Newfoundland.
Yep.
In the fair return for Newfoundland Power, your recommendation was 7.5%.
And 40% common equity, which was 3% more than the generic electric distributor. You've got to remember, you can't look at these are generic ROEs. Adjustments for the utilities I make in terms of their common equity ratios.
So for you, the 7.5 generic ROE is the same. If we are in BC in 2012, Alberta in 2016, British Columbia in 2016, Newfoundland and Labrador in 2018, nothing changes. Basic ROE, always 7.5%, just like the one you're recommending here.
Not correct.
Not correct.
Not correct at all. My recommendation was 7.5% going in to 2011, and I think I recommended for GMI 7.75%, but I'd have to go back and check that. And then we had the watershed event. We had this massive bond buying by the central banks that have depressed long-term Canada bond yields far below any trade-off that a normal person makes between bonds and equities. We had bond yields last year of 1% when inflation was still above 1%. So when you take into account those bond yields are fully taxable for an ordinary investor, we had seriously negative bond yields. No rational investor invests on seriously negative bond yields. So the argument then, after 2011, when we got into 2012-13, the waiting for Godot period, I said, I'm not going to change my allowed ROE until we get a bond market that reflects the trade-off between equity and bond investors trading off risk versus return, instead of having a central bank determining the long-term bond yield. And you're forgetting that during these periods, I recommended a base rate, and I also recommended an automatic adjustment ROE formula, as I did for Gazifère, which the Régie adopted in 2010, and as I did for Energia, I think in 2011, which was adopted. So there also is the automatic ROE formula, which would have adjusted the allowed ROE based upon my recommendations.
Dr. Booth, when did you start working on your expert evidence for this case? I don't need a precise date, but we know it was filed in April of 2022. Do you know when you started working on it? Approximately?
I'd have to go back and look at my files, and it would be when IGUA approached me and they sent me some documents.
Okay.
So I would say it must have been November.
Okay.
I'm just guessing, but
in late 2021 would be fair enough, or fall of 2021.
Yep.
Now, is it fair to say, Dr. Booth, that when you started to work on your expert evidence, or even before you started to work on your expert evidence in late 2021, you already knew that you were going to recommend 7.5% ROE for Énergie, correct?
That's correct. The key feature really was the business risk, not the ROE.
I might be done. Est-ce que vous pouvez, Monsieur le Président, me donner quelques minutes? Je vais consulter j'ai peut-être besoin de plus de temps qu'habituellement parce que les experts ne sont pas avec moi dans la salle. Je dois les rejoindre là, à distance.
Faites vos vérifications. Puis,
peut-être un 10 minutes.
Dans ce cas-là, on va prendre la pause tout de suite.
Parfait.
Et au retour, on verra si vous avez des questions additionnelles.
Excellent. Parfait,
donc,
merci beaucoup.
14h20, on se revoit à 14h35.
Parfait, merci.
Dr. Booth,
Well, Dr. Booth, you'll have the chance to see me in two different angles, so choose what's better. Nice to see you again. It's since 2010 and 11. It's been a while. Dr. Booth, I will be referring you to two exhibits. First, Exhibit B 0015, which is Dr. Villidson's direct testimony at page 61, and this is what she answered to question 56. Page 61, question 56. Yep. So the question, what values do you use for the risk-free rate of interest? And Dr. Villitson answered the following: I use the yield on a 30-year Canadian government bond as the risk-free rate for purposes of my analysis, recognizing the fact that the cost of capital set in this proceeding will begin in 2022. I rely on the forecast yield on Canadian government bond yields in 2022. Specifically, consensus forecast predicts that the yield on a 10-year Canadian government bond yield will be 1.9% in 2022. I then adjust this forecast yield upwards by 40 basis points, which is my estimate of the representative maturity premium for the 30-year over the 10-year Canadian government bond. This gives me a lower bond bound on the risk-free rate of 2.30%. This gives me a lower bond on the risk-free rate of 2.30%. Additionally, I consider a scenario where the risk-free rate of interest is 2.47%. Now, in your evidence, CSIG 0037 at page 2, in the executive summary, you write the following. I base my LTC yield on the forecast from the Parliamentary Budget Officer and the federal government budget briefing, which itself was based on consensus values from the private sector. Consequently, I use a forecast LTC yield of 3.37%, which is still below the 3.8% rate I use as a trigger for changing my estimate of the allowed ROE. Further, it is also 1.13% lower than the 4.5% I use in the 2011 GMI hearings. Now, we've talked about this abundantly in your in your testimony and then in your cross-examination. Taking into account the various economic, financial, and geopolitical uncertainties that we're facing right now and that we're living through, can you please provide your thoughts on a likely range of long-term Government of Canada bond yields over the 2022-2024 horizon? And in your answer, if you can provide your assumptions about the role or actions of the central banks in the financial markets.
Wow. That's a very, very, that's, so how long have we got? How many days? If you're dealing with 2022, 2023, and 2024, then I think clearly 2022 is halfway through. So I think if I look at RBC's June forecast, which has basically their forecast for 2022, now that half of it's gone, would be about 2.5% for 2022. And then they're basically saying the government's going to be successful in bringing down inflation, and we're going to have 2.5% or thereabouts for the next couple of years. So I would say that there's one scenario, which is the government can bring down the rate of inflation. And we see the yield curve. Short-term interest rates are basically the same as long-term interest rates. So we're definitely trying to slow down the economy, which means putting people out of work. RBC seems to think that's going to be successful. So I would say a range of 2.25% to 2.75% based upon RBC's optimistic scenario. I personally believe that the consumer spending is too strong to be brought down with more significant interest rate increases, in which case we could easily see a continuation of inflation, and we could see 3 to 3.5% interest rates over that same period. Not quite as high as I anticipate based upon the PBO's forecast, because they're looking a little bit longer. They're looking out to 2025. But I don't think we'll get to my 3.8% trigger. But I do think that there's a strong possibility that the Bank of Canada won't have the stomach to put short-term interest rates up high enough to break the inflationary spiral. And I wouldn't have said this a month ago. I would have put more faith in the Bank of Canada. But as I said in my direct, we're beginning to see the signs of unions asking for catch-up on the rate of inflation that they see over 2022. And that will flow through into higher prices and make it that much more difficult for the Bank of Canada to bring down the rate of inflation. They're committed to doing that. But I'm just wondering whether the government's got the stomach for interest rates going up, not just another 75 basis points, but going up another 2%.
Thank you. What would be, in your view, an increase in long-term interest rates in Canada that you would consider unusual, and for an unusual drop? So what would be a rise and a drop? In one or the other scenario, could you please explain how such an unusual rise or fall could occur?
Okay, can we go to my Appendix B, Schedule 6?
I think it's
Dr. Booth?
39.
Schedule 6 of my Appendix B.
So it's SIG 39.
C'est ça. C'est pas 40, c'est 39.
So this is a model I've been using for some time now to address some of these questions. The two primary drivers of long Canada interest rates are the risk involved in holding those bonds, which is interest rate volatility, and the supply of those bonds, which is basically the government's deficit. governments run deficit, they increase the supply of bonds to the market. And that tells us how government deficits, the supply side and risk affects the interest rate, the long Canada rate minus inflation, the real interest rate. And then you've got politics. I'm really a political economist because you cannot separate politics from economics. And I've got 4 dummy variables there, which just indicates these are special periods. Obviously, the Second World War was a special period. During that period, given the deficits the government of Canada was running, interest rates were 5% below where they should have been. They were controlled. Then in the 1972 to 80 period, they were 3.6% below where they should be. And that was a period what we call petrodollar recycling, where the enormous increases in price of oil acted as a tax on oil importing countries like Canada, as we were at that time. More recently, I've been including periods for DUM 3 and DUM 4. DUM 3 is the period basically that we've been living in since the 2011 GMI hearing. Since that period, my best estimate is the actions of central banks have depressed the real interest rates by about 2.6%. Huge reduction in the real interest rate because they've been buying bonds. You do not take $20 trillion of bonds off the bond market without having an impact. So another way of saying that is if we'd had that $20 trillion dumped on the bond market, interest rates would have been 2.6% higher. Then on top of that, we got the special years 2020 and 21, which are the COVID years, when even the Bank of Canada started buying government bonds. But to put things in perspective, Mr. Legault, the government of Canada has doubled the national debt in the last 6 years. Doubled. We have twice as many government of Canada bonds out there than we had 6 years ago. They're not being held by private investors. They're predominantly being held by the Bank of Canada. And if those government bonds had been dumped on the market, we wouldn't be seeing these dramatically low interest rates. Now, this is up until 2021. Since then, the Bank of Canada has started letting bonds run off, not being reinvesting. So we've seen some reversion of interest rates to where they should be. But where they should be right now, several percentage points higher than they actually are, based upon the amount of government debt that we have, the amount of deficit financing, and the volatility of interest rates. So what we've got is essentially a special situation resulting from this massive bond buying on the part of central banks. And I don't see that that's going to end very soon because the impact, particularly, as I said, on millennials, Generation Z, younger people trying to buy houses, if we suddenly bumped up interest rates to the order of 2, 3, 4%, there will be a lot of unrest and a lot of people would start losing their houses and house prices would come down. So there's a political, economic sort of nexus between where interest rates can go and the level before the government starts losing by-elections and loses office. And as I said, we're probably going to see problems in the United States with the midterms in November.
Thank you. Under the hypothesis that the regime would approve a 7.5 ROE for the Quebec gas utilities as per your recommendation, if such an unusual rise was to occur within the next 3 years, do you think that the 7.5 rate of return would still be appropriate? And the same for an unusual fall. I mean, strong variations.
Unusual fall, forget about it. It's not going to happen. Not unless we get another pandemic. The interest rates are going to go up, not go down. And how fast they go up depends upon the actions of the central banks and whether we continue to have deficit financing at the federal level. Remember, every time the government runs a deficit, it's basically increasing the supply of bonds. And as the supply of bonds increases, the price will then go down and the yield will go up. So I think the interest rates are only going to go up. I'm a firm believer, as you probably know, in an automatic ROE adjustment model. It's been less of a factor for the last 10 years because my recommendation, as Mr. Ouellette pointed out, has basically been the same, because I do not buy the idea that current low interest rates affect the overall equity return. Equity and bond markets are separate markets in the capital market, and there's not an automatic one-to-one relationship in the fair rate of return and the government bond yield. So I would prefer an automatic ROE adjustment mechanism. This is not on the table in this hearing, but I recommend that if interest rates go up significantly above my trigger of 3.8%, at the very least, the allowed ROE should go up by 75% of the increase in the long Canada bond yield, forecast long Canada bond yield. That was the beauty of automatic ROE adjustment mechanisms, that basically we stopped using them about 2015 or so, when people started facing up to the problem of unusually low interest rates.
Again, in your direct evidence, CSIG 0037, page 25 this time, you mentioned that the Bank of Canada's 2% target rate of inflation within a 1 to 3% band was renewed with the Government of Canada on December 13th of 2021. In Exhibit CSIG 0064, which are your answers to Dr. Villetsen's IR, number 1, and I would refer you to page 12, your answer to her question 12.1. So, yes, question 12.1 was, in Dr. Booth's view, will the presence of high inflation would cause investors to require a higher equity rate on return? The answer was possibly, but the important fact is that the break-even inflation rate is so far well within the 1 to 3% target inflation range, so the markets do not believe that the current high headline CPI inflation rate will continue. Dr. Booth believes that the Bank of Canada will get core inflation under control since they recently, in December 2021, signed an agreement with the Government of Canada to continue the 2% target inflation rate in a 1 to 3% range. If during the 2022-2024 period, a scenario of stagflation caused in particular by the geopolitical situation, leads inflation significantly above the 1 to 3% band set by the Government Canada, can you indicate and explain what would be the likely level of Canada's long-term bond yields?
First of all, we have...
I'd love you to have a crystal ball. I know you don't have one, but your best guess.
Well, Mr. Ouellette has just pointed out that I was wrong in February and March, but I was wrong just in the way the Government of Canada and the Bank of Canada was wrong, and all economic forecasters were wrong. The reason being, we were looking at supply side effects. And I'd have to say, I mean, I've got no crystal ball. I look primarily at the capital markets for what the capital market is telling me, which is the break-even inflation rate, which is well within the 1 to 3% range and close to the 2% target. So that's what the capital markets are telling me. They're telling me that Tiff Macklem is going to get inflation down. Now, the question you asked is he going to get it down over the test year periods of the next, say, 3 years, for example? There, I think there is a real credibility problem with the Bank of Canada and the Bank of England and the Federal Reserve and the European Central Bank, because they all missed this. They looked at the supply side and said, well, these supply side shortages, China will get back, we'll get all of the chips we need, we'll get our supply chains in order, and everything will sort of get back to normal within a year. It's a short-term effect. What I think they ignored was the demand side, which is this enormous amount of savings and pent-up demand, and the power of us as individuals. The fact is, we are causing inflation, not so much the supply shocks, it's us. Now, I don't know about you, Mr. Legault, but my wife has me going to Paris in July. And she wants to go to Paris because we haven't been anywhere for 2 years. So we're going to spend our anniversary in Paris, and we're going to travel around Switzerland. And we're not unusual in that. A lot of Canadians are traveling, and a lot of Canadians are spending money. So it's the power of the consumer that's driving inflation at the moment as much, if not more, than the bottlenecks. And I don't see, perhaps Tiff is going to get it right and we're going to get a soft landing. But my fear at the moment is more chance that inflation will gather speed and sort of get a little bit embedded, and the Bank of Canada won't have the courage to put interest rates to where they should be to slow down the economy. So I would suspect over the next 3 years, inflation is not going to get down to 2%, despite what the Bank of Canada says. So this is where Mr. Hulot took me to task for saying, I doubt. But when I say I doubt, it's because I'm looking at some of these forecasts and I just see how strong the consumer is. Currently, RBC has a credit card tracker. We collectively are spending 30% more than we did before the pandemic. And that's the buildup of all of this spending by Canadian consumers. And that may be starting to taper off. In the face of interest rates, people may start to be a little bit more conservative. But I'd say there's more possibility of an upside than there is of a downside, i.e. inflation coming down to 2%, rather than having some embedded higher rate of inflation for the next 3 years.
I hear you, but my question was in the scenario, and it's been talked about here in Quebec. I mean, Gérard Filion, who is a well-known economic commentator at Radio-Canada, mentioned it only last week, that economists in Quebec are fearing a stagflation scenario. So my specific question is in a scenario of stagflation, what would you think that the bond yields of Canada, long-term bonds, should be or would be?
Well, sorry not to be specific, Mr. Legault, but we do not have stagflation. We have a very strong consumer. We have 3.1% real economic growth at the moment. And as long as the consumer keeps spending, it's going to take a lot for the Bank of Canada to slow down the rate of economic growth. So stagflation means basically stagnant economy with inflation. We had that in the 1970s into the 1980s because of this huge this huge tax increase imposed on us by OPEC in terms of oil prices. We don't have that now. We just have an incredibly strong Canadian consumer. And we don't have stagflation, and I don't think we will have stagflation. We're more likely to have a strong economy growing at faster than the underlying real economic growth, and a Bank of Canada unwilling to increase interest rates enough to slow that down. So that's not stagflation. That's economic growth, old-fashioned Phillips curve of rapid economic growth and inflation.
Okay, maybe more of a general question, but could you tell us about the difference between the inflation that should be taken into account in the rate of return and the one that should be taken into account when looking at the revenue requirement? Are they two different things, and what differentiates them?
They are different. In terms of the revenue requirement, you have to take into account the inflation of the costs that Énergir and Gazifère have, which reflect whatever they negotiate in their labor agreements and what they're paying for the commodities, which reflects current inflation. So whereas in the capital markets look beyond the current next 3 months or 6 months. So particularly in the bond market, as I said, we see the break-even inflation rate, the core underlying inflation rate assumed by bondholders, 2%, not the current inflation rate. But in the revenue requirement, you have to take into account whatever the rate of inflation is or cost increases on the items that go into the revenue requirement, which is not the long-run inflation that's in the capital market.
I'll ask the question anyways. I know you don't believe that there is a situation of stagflation, and you don't see one coming in the near future. But in the event that there was stagflation or attributable to the current geopolitical situation, and that any economic situation would cause inflation levels above the 1% to 3% band. Can you comment on the relevance of taking this inflation into account in Énergir, Gazifers, and Intragaz rate of return by a premium or a compensation factor?
Now, I've been doing this since 1985, Mr. Legault, so my memory goes back a long way. But when we had stagflation, even I wasn't providing testimony at that stage. And it was a period, as you correctly stated, of stagnant economy, very low growth, and significant inflation. The equity markets feed off growth. So with a low growth environment, equities didn't perform very well during the 1970s. So if we go back, and I have to think of myself in terms of the 1970s, it will pick up in terms of the equity required rate of return, because equities do not like a lack of real economic growth. They expect to see real growth, inflationary growth. Fair enough, that's a trade-off between bonds and equities, but a lack of economic growth is bad for the stock market. And the 70s were bad for the Canadian stock market. It's not an accident that after the Bank of Canada broke inflation in 1981 by very, very high interest rates. And as I said, that's when I had a mortgage and I was paying over 23% on my mortgage. My students throw up their hands. They just don't believe it. But that's what I was paying for a third mortgage. We broke the back of inflation, and we've had a huge boom in the equity markets ever since. So the equity markets like real growth and they like low inflation. It makes things predictable. So if we get stagflation, I suspect the equity costs will go up quite significantly. And okay. Mr. Willett might even see me recommend more than 7.5%. That's a joke, by the way.
Looking at the issue of preferred shares in the capital structure. Now, we know, and we've heard Dr. Villitson say that she gets rid of them. She doesn't take them into account because they don't exist, essentially. They're not there, so let's get rid of this in the formula. You maintain them for your own reasons, but in this debate about preferred shares, how should when setting the rate of return, how should the deemed income tax or the fiscal aspect be factored in the Régie's decision for the three gas utilities?
So you're talking about the fact that if you deem preferred shares at 5%, then it basically means that there's a higher income tax component? Is that what you're saying? Yes. I view the Énergir as having 56% common equity because there are no preferred shares. It really is 46% common equity at an equity rate of return of about 8.25%, because that's the average of the 8.9, and I think the preferreds were deemed at 5%. So I view Énergir as being 46% equity financed. The rating agencies view Énergir as being 46% equity financed. And that's a support for the bond rating, and it is expensive. Whenever you look at debt versus equity, it's not a comparison of, say, I think Dr. Villotson had a 3.2% A bond yield in some of her equations, and the equity cost is, say, 10.5%. That's not the comparison. The comparison has to be on the same tax basis. And equity at 10.5%, if you gross it up for the tax component, it's really costing closer to 13%. So there's the tax penalty to equity that you have to take into account. So that's why you only give equity to a firm that really needs it in order to balance off the business risk. And I'm happy with my 46% equity recommendation and a continuation of the preferred deemed component, because I regard Energia as being risky and significantly risky. Otherwise, I'll be recommending the same 37% as ATCO Gas, or the same 36% as Enbridge, or the same 38.5% as FortisBC Energy. So I hear you on the tax component, but you've got to sort of think in terms of what is the fair rate of return, the overall cost, bearing in mind the risk of the utility. And I'm happy with 46% equity with 7.5% deeming. It's worked. And I think that's the right way. Traditionally, I've said that's the right way of adjusting for its higher business risk. I don't agree with the extra 30 basis points on the generic ROE, because that's sort of taken in the higher risk of Energia into account in two ways. One in the ROE and one in the common equity ratio. And the common equity ratio with basically 46% is so large relative to other gas utilities, I think that's more than enough compensation. And that's the same as I've been saying in every hearing going back at least to 2007.
Thank you, Dr. Boot. No more questions, Mr. Chair.
Merci, Monsieur Legault. Madame Falardeau.
Hello, Dr. Booth. I think you answered most of my question, but just so that I don't find myself having to decide and wishing you were there, this question of keeping the preferred share, I'm having a difficult time identifying the advantages and disadvantages. And one of the things you said last Friday was you're proposing that we keep the preferred share in the capital structure because, well, if it isn't broken, well, you said, why change something that works? If it works, don't change it. So what I'm understanding today is that you're saying, well, Energia does present or have greater risk, so it would be compensated by having preferred shares. So did I understand correctly? Because to compensate the greater risk, because I understand we've been saying there's no business risk and the financial risk is taken into account with, other things. But now you're saying, no, there is greater risk and keeping the preferred shares in the structure is going to compensate that risk. Did I understand that correctly?
I think broadly you've got it correctly. The National Energy Board had a very nice quote which said that it understands that deferral accounts reduce the short-term risk, the earned versus the actual, but in long run you cannot deny the forces of supply and demand. And the same thing applies to Energia. And as I think I mentioned in that presentation, when I said years ago that the Energia earns its allowed ROE, the chairman of the Régie at that time, I'm pretty sure, I can't remember the exact things he said, but he said words to the effect, oh yes, but we have to protect the utility. They have lots of deferral accounts in order to make sure that they earn their allowed ROE. So the real business risk is the extent to which the regulator has to dip into its powers to protect the utility and make sure that the rates are fair. And we saw that, for example, with the National Energy Board and the main line, when it faced this huge drop in the the throughput on the main line in 2011, it relaxed interruptible service. It dipped in to allow the main line to do things to continue to earn the allowed ROE. More risky utilities may earn the same allowed ROE, but the regulator has to do things in the case of a riskier utility to make sure that happens. So in the case of Energia, I've always felt that the competitive fixture of electricity versus natural gas in Quebec is more tenuous than it is in other provinces. So there's absolutely no question that ATCO Gas, as far as I'm concerned, is and Enbridge are very low risk gas utilities. We don't have a lot of competition from electricity in Ontario. In fact, we lost it. The previous provincial government lost the election because of high electricity prices in Ontario. So that's not the situation you have in Quebec. And ATCO Gas simply has very little costs in delivering gas in Alberta. So when you compare Energia with the other three big utilities, I have no question whatsoever that the underlying business risk of Energia is higher than the other utilities. And that is only going to increase in the future when you start getting even more carbon taxes, when the margin of competition between electricity and gas gets smaller and smaller. I don't see it as a problem for the next 3 years, but as the gas carbon taxes increase, it is going to be a bigger threat to Energia. And that's why I would like to see Energia and Gazifère putting together a proper filing in which they actually specify the forecast demand, they have a demand equation, they specify all of their costs, and they illustrate how their rates are going to have to change and what the margin of competition is over the future test period, so we can actually assess the risk that the utility is facing. At the moment, we don't really have a record, apart from these generic, or there's risk out there, we don't have an assessment of how that risk is going to affect the utility. Does that answer your question?
Yes, thank you very much. You were very generous. And just one more question. Then could we apply that same logic to Gazifère and consider that since it's a Quebec distributor, it's also facing greater risk and therefore should have the similar capital structure to compensate and have preferred shares in its structure to compensate for the greater risk?
I would like to see Gazifère doing. I'm using the Fortis Energy BC analysis of energy in Montreal, gas versus electricity, and the size of Energia. Those are sort of definite things that I can hang my analysis on. Gazifère, I just look at it as integrated within Enbridge. It doesn't get its gas off of TQM. It gets it from the same system as Ottawa. From the Enbridge system and from TransCanada to the Northern Ontario line. So it doesn't have the same problems as Energia in some areas, but it is primarily residential. And as yet, I do not have a clear handle on how that higher regulation from the province of Quebec is going to affect Gazifère. So, and in particular, I've heard a lot about what the City of Montreal is going to do. I haven't heard a lot, or at least as much, on what Gatineau is going to do and exactly whether they're going to put restrictions on gas in certain areas. So I can honestly say I'm not as comfortable with Gazifère, except for the fact it's integrated with, de facto, it's integrated with Enbridge. But I repeat again, I'm not recommending a 36% common equity ratio for Gazifère, which I would, obviously, but for the provincial boundary and these special factors attached to that part of the Enbridge system. But I view it as being part of the Enbridge system.
Okay, but you're recommending it for Intragaz, since being integrated almost with Energia, then it's facing similar risk as Energia is facing.
That's correct. And I actually went back to my testimony for Intragaz. And at that point, Intragaz was a relatively new storage, and most of the risk attached to a storage occurs. It's operational risk. It occurs in the first few years of the development of a storage facility. And of that, originally, Energia wanted Intragas in its rate base. At least that was my understanding. And at that time, the Régie said avoidable cost, because you could possibly get the same services by other means, backhauling from Dawn and using other vehicles rather than using Intragas. I basically said, well, it's sort of like Union storage. Except that Union can sell the storage facilities to other pipelines that access its system at Dawn, whereas Intragas is completely integrated with Energia. So I really would recommend exactly the same rate of return and financial parameters for Intragas. The only thing different is that it's got a minority ownership, but it's got a 10-year contract, just renewed with Energia. So on one hand, I say there's no risk or very limited risk. On the other hand, I say, why treat it any differently from any other assets that Energia has got to provide service to its whole system? And it needs some form of storage to provide seasonal supplies of natural gas.
Thank you very much. That's all my questions. Thank you.
Merci, Mme Falardeau. Il n'y aura pas d'autres questions de la régie. Alors, Maître Hamelin, est-ce que vous avez d'autres questions pour Dr. Booth?
Est-ce que vous me donnez 5 minutes, ou en fait, peut-être moins que ça, là, juste que je compare avec mes gens?
D'accord.
Merci. Mr. Chairman, I will have no further questions for Dr. Booth.
Merci. So, Dr. Booth, thank you very much for your availability. So there will be no further questions for you. So you're done with the régie for today.
Thank you. I just wish I could have come to Montreal.
Yeah.
Thank you.
Thank you very much. Juste deux petits points.
Merci, Dr. Booth. Pardon, merci, Dr. Booth.
Thank you.
Subject to your undertaking, I'll be contacting you on that.
Okay.
Oui, juste deux petits points, puis là, je vais vérifier avec vous, Maître Hamelin. Donc, vous allez nous déposer la décision D2020-147 en anglais sans vos commentaires.
C'est D2010.
C'est 2010, excusez-moi. Oui. Et
oui.
Comme vous venez de mentionner, vous avez pris note de l'engagement numéro 5 là, pour les feuilles de calcul dans le document du Dr. Booth.
Tout à fait.
Et on se revoit demain. Ça va être assez pour aujourd'hui, je pense. Et on va se revoir demain à 9 h pour la présentation du panel numéro 4 de la SIG.
Parfait.
Parfait.
Merci.
Merci
beaucoup.
Bonne fin de journée.
Tout le monde. Au revoir.